Street yesterday and will continue to be something we watch today. With that in mind, we saw German, French, UK 30-year yields all jumping more than 10 basis points in yesterday's session, really following what the Treasury market was doing. Higher yields at the long end. And just checking in on what's going on the German 30-year yield, we again see some selling there and the yield going a little higher. Nothing like the scale of the moves we saw yesterday, but worth just keeping those in mind. And iron ore, ongoing focus there because commodities have been weaker. That's iron ore, it's steel, it's the oil price, all weaker overnight coming through the Asia session, and often that is something that helps to set the mood in London, so we keep that under review. Iron ore a little weaker. Let's have a look at the futures picture then. All of that understandably adding up to a little nervousness as we go into the start of the European trading day. DAX, FTSE and CAC futures all suggesting will be a little bit weaker. CAC futures in particular down by 0.7%. So the start of the European trading session, and the FTSE 100 is the first to open as usual. Risk aversion clear to see across this GMM screen. We have not only selling of stocks, but we also have the selling of sovereign bonds and those yields going higher. That continues to be a theme for another day. Not on a scale of the moves that we saw yesterday, but it's still early. We'll see what happens as we get closer to the US trading session. The pound, the Swiss franc, the euro, all of those weaker against a resurgent US dollar. Many people asking in the last month whether we'd seen the peak in yields. Had we seen the peak in the dollar? Well, so far that seems to be elusive, and we see that the dollar goes higher as these yields go higher. We've got the Spanish IBEX now open, the French CAC 40 open, and all of that movement seems to be to the downside. So negativity coming through across European equity markets this morning. As I say, higher yields, something to watch. Also, the negative downdraft from the China story overnight. More on China in a moment. Let's have a look at how this is playing out from a sector perspective. It feels as if it's one of those days where we might not see many areas of green. There we are, no areas of green right now. So the stock 600 down by 0.5%. It's pretty widespread in terms of the geography of this move, and it's pretty widespread in terms of sectors as well. Some of the worst performing appear to be technology, down by 1.3%, or that is the worst performing I can see on my screen at least. And that really does make sense. It's in keeping with the moves we saw on the Nasdaq yesterday, in keeping with the US futures picture, where Nasdaq futures do look a little weaker than elsewhere. And really, this is all to do with higher rates and what that does to those to the stocks such as technology, which do less well in a higher rates environment. Let us put some of these market themes together. Sophia Horta-Acosta joins us today from the Markets Today blog. And the higher rates story is one of the things we're focused on, Sophia, for sure. The other is the negativity coming through from China. Take us through some of the latest news lines and what matters really on the China story this morning.
Yes, Anna, I mean, what is new really? Because we've been looking at the China story really kind of feeding through to European markets for much of the year, and that's really kind of taking kind of fresh momentum now. What we're seeing is Evergrande, so this is the kind of the poster child of China's property crisis, has to revisit its restructuring plan. And I wrote almost 2 years ago now, I wrote a story saying the nightmare scenario for Evergrande will be an uncontrolled crash, and it looks like that's what we're going to get if it doesn't manage to reach that agreement with shareholders. So that's one concern. Another property developer, Country Garden, is still trying to avoid a default. Oceanwide says it's facing liquidation. So we have just so many property developers still struggling. Still, there's no cash flow coming in from home sales. We did see kind of a spurt of home sales in August when Beijing rolled out those stimulus measures, but that is losing momentum, and we're heading into a very, very key holiday season season that starts on Friday. So people really kind of trimming risk ahead of that.
Yeah, that's really important, isn't it? The way we're seeing positioning ahead of that holiday, Sophia. And I do rely on you to give me a sense of when we need to put the Chinese property sector front and center, because it could be a story every day, couldn't it? It could be something that kind of captivates the market every day. So long has been this negative story. So long have we been focused on this negative story around China property. Let's take that into other China assets then, and the yuan in focus. I see that the yuan has been flirting with its daily trading limit, really testing one of China's red lines. What do you make of the moves in the Chinese currency?
So essentially the yuan can move 2 percentage points either direction of the daily fixing that the PBOC set. So the daily fixing is what the PBOC uses essentially to guide the currency, to weaken it if it wants to, and also to protect it. And it has been using that. It hasn't been working. So essentially what traders are doing is pushing the yuan to the weakest it can trade on a daily basis. And that's quite concerning for the PBOC, because the PBOC can either weaken the trading band, which essentially suggests that they're giving the green light to further depreciation, and that will kind of encourage more bearish positions on the currency, which it doesn't want to do. It is protecting the currency very, very close to those lows that we've seen in the past few years. But it also, you know, if the currency continues to do this, then essentially there's no liquidity. So is it a market, you know, if the PBOC isn't letting it be? So it's a really tricky situation for the PBOC. What happened in August 2015 when the PBOC kind of weakened the yuan by changing the fixing rate, that really spooked markets. So if it's to do something here, it has to communicate it so that markets receive it quite calmly. I think this is a really, really interesting one thing to watch. And it also, will they widen the trading band? You know, that's also one possibility, a lot for the central bank to think about.
Okay, so a focus on the Chinese property markets and on the currency. And I know we've got data coming out at the end of this week, haven't we? So we'll watch for that as well in terms of sentiment around the China story. Sophia Holter-Acosta from our Markets Today blog, keeping our focus on the China stories we need to know this morning. Remember, you can get all of that, very global, of course. It really matters for global markets. That and the higher rate story seem to be the dominant themes weighing on risk appetite this morning. You can get more on both of those on the front page of the Bloomberg UK website. You can click through to the Markets Today blog. You can also go to TLIV Go on the Bloomberg terminal. Let's check in on some of the individual stocks that are on the move. Joe Easton has an update. Joe.
So we're waiting for a price on ASOS at the moment, but it's not good news as it's been delayed at the open, so it should open up within a few minutes now. But what we can see is we can see Boohoo, the big rival, declining down around 2%, now ticking back up. There we go. We see the price on ASOS down 6%. This as the company reports quarterly sales down 15% and says it's in a weakening in some of the sales over the summer, particularly July and August. They say it wasn't just weather related, it was also due to economic concerns. So that is one of the worst performers today, as I say, weighing on Boohoo as well in the UK clothing space. Then we'll flip over and have a look at a couple of other stocks that we had in stocks to watch, I believe. So here we go, ASM now. It was marginally positive in terms of their guidance. They upped their guidance by around 200 million euros. However, traders that I've been speaking to are saying that this wasn't as much as they expected. We saw earlier those stocks up around 60% year to date. All the chip manufacturing companies are higher, and as such, people are expecting a bit more ahead of this trading update. And those stocks are declining over in the tech sector today. ASM speaking at an investor day later, and there'll be a lot of focus on that. A couple of the other stocks we've got on the screen. BE Semiconductor down 2%, that's over in Belgium, and Extron slipping slightly over in Germany. In terms of the ratings changes, there's a big one over at Morgan Stanley. They upgrade Barclays to overweight for the first time in 6 years. They say that the card business for Barclays over in the US is underappreciated. Barclays is growing new credit card customers over in the US at a rapid pace, according to Morgan Stanley. We're seeing that one rising 1.8% at the moment. Another financial stock covered by Morgan Stanley is AJ Bell. They rate that company a new underweight. They say that the rates benefit for some of the online investing companies has now faded, and they recommend clients sell AJ Bell. We're seeing that one dropping 2%. Then Zurich Insurance, they get an underperform rating over at Exane BNP Paribas, who says that the casualty insurance is not performing as strongly as expected. And finally, Britvic, the drinks maker, gets an upgrade to buy over at Peel Hunt. Now, they say that the weather in the UK has seen the stock decline. This is, of course, mixers for drinks like gin and tonic. They say the weather has weighed on the stock, and that's provided an opportunity to buy in. Peel Hunt recommends buying Britvic, and that one is up 1%.
Okay, really interesting. Lots to keep an eye on then, Joe. Thank you. Joe Easton from our equities team. Interesting to see those tech names not necessarily responding then, the chip names he was talking about there, not responding to some of the positivity in the ASM International statement, but perhaps all instead being sidetracked by the global sentiment towards tech stocks. Growth stocks, of course, not doing terribly well in a period of rising interest rates, and we certainly see Treasury yields continue to rise this morning, part of the global conversation. Now, let's have a look at what is on our global daybook for you and what we need to focus on. At 1 p.m. UK time, the Hungarian Central Bank is due to deliver its latest rate decision. Most economists see a 100 basis point cut, taking its key rate to 13%. Over to the United States later at 3 p.m. UK time, we'll get new home sales numbers and also at the same time, more insight into the health of the US economy with consumer confidence data due out. Valerie Teitel taking us through that really interesting research from part of the Fed, talking about how it's only the richest 20% in the United States that still has its pandemic savings. The rest of the population having depleted those. We will also get an update on the ECB conversation coming up. ECB President Christine Lagarde reiterates her stance on policy to combat inflation. More on that next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We have both the issue of the level and the issue of the length of time, which are two big considerations for the monetary policy decision that we debated at length at our last monetary policy meeting, and which led us to decide to increase by 25 basis points all three rates.
ECB President Christine Lagarde reiterating the borrowing costs will remain elevated for as long as needed. Let's get a view on rates and beyond. Stephanie Niven, Portfolio Manager at 91, responsible for the Global Sustainability Equity Strategy, joins us this morning. Stephanie, very nice to speak to you. So let's take a look at the rate story and how that works its way through what you're investing in and what you're not right now, Stephanie. I mean, we've got two things going on with rates, I suppose. There's a higher for longer narrative, but then there's a how high do we go straight away narrative, which we've kind of gone back to. That seems to be kind of last year's story, but we've gone back to it with certainly what we saw with long end treasuries yesterday, rates on the rise still this morning. What are you focused on when it comes to that treasury story?
Sure. Well, I think we've seen a bit of change within the market. So we went from a recession is coming to a Goldilocks to perhaps more of a recession is coming again situation. And we very much believe, you know, that rates are higher for longer. We buy into that Table Mountain view of the world. And we think that has some really interesting ramifications for companies. You know, we heard Jamie Dimon out yesterday talking about higher rates for longer and what that could mean and whether companies are prepared. And I think ultimately for us, it means leaning into those opportunities where those structural drivers of, you know, growth. And we think that's really compelling. We think that there will be a real stock pickers market going into 2024 when we will see these rates stay higher for longer and cause, you know, some different complex situations for companies that are levered.
And does it, yes, and talking about the amount of leverage that some companies have, the amount of gearing maybe, does that mean then a deep dive back into the balance sheets? What do debts look like? How are they funded? And crucially, what's the profile of repaying those debts, getting refinancing? Because some people who are not worried about higher interest rates and company balance sheets tell us, well, companies spent a lot of time in the post-GFC environment of low rates refinancing then, and so actually they benefit from low rates for a very, very long time. I suppose that's core to your stock picking right now.
Sure. I mean, we saw that push out of duration in 2020. We saw, you know, consumer balance sheets remain strong. And I think that in the next year, in the next 12 months, we will start to see the market recalibrate that growth, looking at those companies that can generate return, that are growing into areas where, you know, we have that need, we have those sustainable drivers underpinning. And we can see it across the globe. We see it in the US with the IRA winners, in train technology, you know, in waste management, for example. But we see it in Europe, Schneider Electric, fantastic energy management business that will grow regardless of the macro environment in Europe. And the UK, again, has some compelling opportunities. And it's been really interesting to see the way in which the rate story has really leaned on sustainable investing. You know, we've seen that transition from peak positivity, perhaps 2 years ago in sustainable investing, down perhaps to maximum negativity now. And that's been driven in part by rates, but also we have this anti-ESG sentiment, and, you know, we have that negativity on EMs, and, you know, you've covered that China story, that property element, you know, pretty extensively already.
What about the focus on sustainability and what that does to the borrowing costs that companies face? Are you seeing companies that are in those areas of growth that you identify, very sustainable businesses, are you seeing that they can take advantage of much better borrowing conditions? Is the market dissecting things that way?
Yes, of course. There's a lot of fundamental appraisal right now on those capital allocation decisions that companies are making. You know, will this project have that compelling return? Or actually, are we beginning to see a bit more scrutiny on those perhaps more speculative capital allocation choices? And I think that's the right move for the economy. You know, we want to see that consistency and commitment to green goals, to moving towards tackling the US SDGs. And I think we'll begin to see that going into 24. And I think that's a really exciting time to be a sustainable investor.
Okay, and just sticking on the green theme for a moment, Stephanie, I have to reflect on the fact that we saw some political backtracking around green themes, particularly around cars, last week from the UK government. How does that influence thinking, appetite for sustainable investing?
So we've seen it from the UK, we've seen it a bit from Germany overnight as well. And ultimately, no transition is a straight line. Things will come, you know, with bumps in the road. But we do need to see that clear consistency and that clear commitment coming from governments. We need to see governments, particularly the UK, looking to reignite investment into the UK. We want to see committed policy, predictable policy, and that long-term, deep sector level commitment. And that's what, you know, we need to see to drive that opportunity forward. And flip-flopping from the government government, that's not a compelling situation to be in. But ultimately, within our sustainable, transition, there are three vectors. There's technology, there's consumer behaviour, and there's regulation and government support. So, we see that those two elements of technology and consumer behaviour, particularly in the support for the EVs, where we are seeing penetration of EVs, we are seeing that compelling consumer-led growth story coming through. That is still intact, and we think, we are on a trajectory that will see bumps, but this is a compelling opportunity to invest in sustainable.
Okay, so government commitment, only part of the story. Back to the rate story, which is so dominant this morning. We continue to see Treasury yields going higher. That's weighing on technology stocks, weighing on growth stocks this morning. I mean, Jamie Dimon at JP Morgan has been talking about a world not being ready for 7% rates. And he makes a distinction between, he says that's a worst case environment. We're not necessarily going to get there, but it would be harder for the world to go from 5 to 7 than from 3 to 5. Is that something that you also think the world is not ready for? How high do these rates go then, do you think, Stephanie?
We think there's probably another rate hike coming this year, but I agree with the broad view that it's higher for longer into next year, and that's where we will keep seeing the focus. And over anchoring on exactly how high the rates go, perhaps miss the fact that companies need to think about the return potential and trajectory of the capital investments they are making. And that overall will be great for the economy because we will see those long-term value creative projects come through. I mean, the consumers, that's a slightly different story, and we're beginning to see a few hints of the US consumer and the UK consumer this morning with hassles come through. And it's the consumer balance sheet that looks to be slightly unwinding here and beginning to have a bit of an economic impact from here.
Yeah, let me ask you about the US consumer then. Some research from part of the Fed talking about it's only the richest 20% of Americans that still have excess savings from the pandemic. Are you concerned then? We talk about higher rates for longer, but I guess that view slightly threatened if we see a real downturn for the US consumer through the winter.
Sure. I mean, the strength of the US economy that we have seen perhaps suggests rates don't need to be cut into 2024, but they will remain higher for longer. And you're right, consumers have come out of the pandemic, they've come out with strong balance sheets. There was excess capital liquidity through the pandemic, and that is beginning to unwind, just as the corporate balance sheet stimulus that we saw in the pushing out of rates, that is beginning to unwind too. So I think we're at this really interesting uncertain period in macro outlook. We expected last week to give us a lot more clarity, and it hasn't. But I think that means, for active investors, for stock pickers, for portfolio managers, it's time to do your work, and it's time to, really think about where those businesses that have that growth opportunity, pricing power, and resilience of margins, where they sit. Okay, Stephanie, thanks so much. Thanks for joining us. Stephanie Niven, portfolio manager at 91. That conversation around higher rates and what it does to corporates, really interesting. What investment decision our business is making? Well, we know about one. Coming up, Airbus beats Boeing in a winner-takes-all deal with Air France. Details on that, more on the aviation sector next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 23 minutes into our European trading day, and European equity markets are looking negative this morning. Technology stocks in particular being sold off as a result of the higher rates environment. Treasury yields go higher, and we see some of that replicated in Europe this morning. Now, Airbus just got a leg up over its arch rival Boeing thanks to a massive new order. Air France-KLM is renewing its long-haul fleet with an order of 50 Airbus A350s and purchase rights for 40 additional aircraft. The order will make Air France-KLM the single biggest operator of the jet. In terms of what this is doing to various share prices this morning, I mean, Air France-KLM a little weaker this morning, down by 1.3%. Let us get to Benedict Camel, who can give us details on what's happening here. Benny, good morning. So what did Air France-KLM pick, or why did they pick Airbus over Boeing?
This was the end of a 7-month campaign. We heard from the Air France CEO last night, and he interestingly said, this could have gone either way, but ultimately we went with Airbus, and the reason for that was a range of decisions. One was the performance of the aircraft. Does it have the range that we need? You need to remember, a lot of these planes need to circumnavigate Russia at this point, so you need extra range, and that's something that the plane offered. Price, obviously, is an important decision here. When you make an order of this magnitude, you're going to get very good concessions on these planes. So Airbus, obviously, in the words of Air France, was able to be more aggressive on their pricing. And then also the availability of these planes. You know, can they provide them at a date when the airline needs them? And again, Airbus was able to come through on this. They're going to provide these planes between 2026 and 2030. And all those things combined ultimately led Air France to go with Airbus on this one. And as you said, make it a winner-takes-all decision.
That's a really interesting point about long haul being slightly longer these days, or a lot of travel taking longer. What does this tell us then about appetite for long distance travel at this point, Benny?
Well, long-distance travel is back, and it's something that took a while to come back. We first, after the pandemic, saw the short-haul operations come back. People were taking these shorter city flights, these shorter beach holidays, and now you've really seen long-haul come back. There is the complexity of the Russian airspace, which is obviously huge, and it's now this sort of big black hole on the map that everyone has to fly around. We've heard from operators like Finnair, who've built their whole business, their long-haul business, on flying to Asia, for instance. It's become very difficult for them. So this is something that these plane makers and the airlines need to consider as they look into their fleet plans. And Air France said, this is something that will stay with us for many years, the closure of the Russian airspace. It's a slightly pessimistic view, but that's the one they're taking. And because of that, they said, this is a plane that can service these kinds of routes, and that's why we're going with this.
Okay, Benny, thanks so much. Bloomberg's Benedict Camel with the latest on the aviation sector and that big deal for Airbus. Speaking of Air France-KLM, this Friday, don't miss our exclusive interview with the Air France-KLM CEO, Ben Smith. That's just after 9 a.m. London time, right here on Bloomberg TV. And I should also say, on the aviation front, throughout this week, we will be live at the World Aviation Festival taking place in Lisbon, their annual conference taking place there. Bloomberg TV will be speaking to leaders and executives in the aviation sector as it continues to readjust to post-pandemic travel trends. Tomorrow, don't miss our interview with the Emirates Airlines President, Tim Clark, the IAG CEO, also joining the team. So lots of conversations coming your way around aviation. Coming up next, though, the UAE is set to host the COP28 climate talks later this year. We will speak to His Excellency Ambassador Mansour Abdulhul, who's the UAE's ambassador to the UK. That interview coming up next. This is Bloomberg.
not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. The Stoxx 600 is lower as 10-year Treasury yields continue to climb, as the Fed's Neil Kashkari says he sees another rate hike this year. JP Morgan CEO Jamie Dimon warns the world may not be ready for a worst-case scenario of US rates at 7%. Evergrande's crisis deepens after its mainland unit defaults on a 4 billion yuan bond. Shares in China extend declines. Plus, the EU's Valdis Dombrovskis warns China's Ukraine stance is hurting trade as Beijing calls for caution from Brussels over EV subsidies. Let's have a look at where we are on the markets then. Welcome back to the programme. Half an hour then into the European trading day, and we've got weakness, in particular falling on the French market, it seems, down by 1.25% this morning. The FTSE 100 a lot flatter than the rest, flattered perhaps by some of the healthcare stocks in London. That's the only sector in positive territory. The Xetra DAX down by 0.9%. In terms of those sectors, then only healthcare trades a little higher. Personal consumer discretionary and grocery stores also a little firmer. To the downside, though, technology by far and away, well, that and real estate, the worst performing sectors. Technology down by 1.7%. Of course, a lot of focus at what we're seeing at the long end of the Treasury curve, rates going higher, an expectation of higher for longer when it comes to interest rates. All of that plays badly for technology stocks, of course, plays badly for growth stocks. And so we continue to see that, just as it was a focus on Wall Street yesterday, now a focus here in Europe as well. So tech a little bit weaker this morning. Let's move our conversation on, though. Later this year, world leaders will gather for climate talks at COP28 at the conference taking place this time in Dubai. The UAE, which holds the rotating presidency, has proven to be perhaps a controversial host. We'll get into that conversation in just a moment. Let me welcome our guest, His Excellency Ambassador Mansour Abulhoul, who I'm very pleased to say joins me here on set in London. Ambassador, very nice to have you with us. Let's get into a little bit of that controversy, and you can give us your view, the way you see it in the UAE, because there's clearly a lot of excitement, I'm sure, going into COP, but there have been some who pointed out the role that big oil seems to be playing in the conversations from your side for the UAE heading into COP. Do you think we've got a clear handle on the role that oil companies should play in these kind of COP gatherings?
Well, firstly, I must sort of set out that there's few countries in the world that really have the relationships the UAE have to host this type of event. But of course, the success of this type of event will depend on a collaborative effort of many countries coming together. UAE has always put climate action at the forefront of its national agenda. We have 3 of the largest solar farms in the world. But when we talk about inclusive, this is about bringing everyone together, including the oil and gas sector, including doubling down on renewables, tripling actually on renewables. So I think we are an excellent host for the country, but one thing I should underscore is the success of these negotiations will be determined by everyone's efforts, how seriously they take those to delivering results.
Okay, so what about collaboration, different countries? You clearly think that oil and gas should have a place at the table then, and that's important. Others would point out that your special envoy, also the CEO of ADNOC, of course, doesn't that lead to some kind of conflict of interest when you're talking about climate change?
I think we can only build the energy systems of the future with the oil and gas sector, with their investment. But we're very clear-sighted about the phase down of carbon emissions, the decarbonisation of the oil and gas sector. And when you look at our own oil and gas sector, we've done that. There's proof in that through clean energy from Baraka nuclear power station. So I think there's a very clear model, example, drive and effort being shown by the UAE to really drive out an inclusive, successful negotiation at COP28 in December.
So we'll look with excitement ahead to COP28 then taking place a little bit later on this year. You're here in the City of London, though, today. I mean, what message are you bringing? This is an important place for the UAE, and the UAE is an important place for the City of London. There's a lot of money flows between the two. What kind of message do you bring to the city then today?
When I think of the financial centres we have in the UAE, if you think of DIFC, it's close to 2 decades established, with deep ties to the City of London. So if we think of conventional finance, if we think of fintech, financial innovation, as well as green finance in the run into COP28, we're really looking to kind of double down on our relationship with global financial centres like the City of London and really build upon this. So I think there's huge scope there. If you think of the MENA region, a lot of it is unbanked. So if you think of new sectors emerging like fintech, I think there's huge opportunity for those companies, British companies that are based here, may have DIFC as their second home to then tap into a wider market on things like fintech.
Okay, and thinking about the relationship with the UK, trade conversations have been taking place. I think from the UK perspective, trade conversations with the GCC rather than individual countries. Any update on any progress being made, any staging posts you're looking ahead to in those conversations?
So I'm glad that we speak at an interesting time. Trade between the UAE and UK is all-time high. If we think back to 2021, we launched the Sovereign Investment Partnership, a very ambitious investment program led by Mubadala Organisation, Sovereign Investment Organisation in the UAE. And to date, we have delivered over £10 billion across key sectors in the UK economy, from energy transition to infrastructure to technology, life sciences. So the free trade negotiations are progressing well, and I'm pleased that all parties have kind of engaged, the 6 member states have engaged, and I hope I wouldn't want to come out with any sort of big statements at this stage. Negotiations are negotiations, they have their own teams, but I'm really sort of encouraged by what can be achieved by deepening our trade links with the UK.
Okay, and thinking about trade links, we've recently seen, of course, the India, Middle East, Europe corridor being signed at the G20 in India. I know that you've been involved with all of that. A lot of people putting that, though, under the microscope, given the geopolitical changes that we're seeing between the US and China. How do you, as the UAE, manage to navigate what seems to be a sort of bifurcating world, a world where many countries might be called on to pick sides? How are you thinking about these global power struggles at this point?
Well, when you think of our trade with India and China, these are 2 top trading partners. It's something we can't really ignore and something we welcome. This is about building prosperity links and bridges. And we very much also see multilateralism as the way forward. So I think the announcement that came with the help of the US at the G20 for this infrastructure corridor will boost trade. But this doesn't come at the expense of our very matured relationships with the US and Europe, where we have deep security and investment ties.
Okay, so it doesn't come at the expense of that. Are you focused at all on some people have called on the UAE to do more, to change the nature of the products that maybe flow through the UAE on their way to Russia, maybe some products with dual use? Is that something that you're looking at in the context of bans that have been put in place by some Western countries?
So the UAE has a very clear policy. It enforces UN sanctions. We are a global financial centre like London, and I think you always need to work on these things, but we have very strict, robust measures in place, and anyone who breaches those regulations there will be enforcements in place.
Okay, do you think that might change at all, the rules that you have in place with regards to products to Russia? Are they under review?
So I think it's a constant process. We have our rules in place. We follow UN enforced sanctions. and it's a process that's ongoing.
Okay, thinking of the mood in the region at the moment, I was reading with great interest how much closer to normalization we are in terms of ties between Saudi Arabia and Israel. I wonder how you think that will change the mood in the region, improve the mood in the region if we do see normalization on that front.
So I wouldn't really be able to comment for the Kingdom of Saudi Arabia or for the State of Israel, but I do believe, it's 3 years after the Abraham Accords was first announced, and any ways we can sort of open up channels of communication. This is obviously for the sovereign rights of those countries to make the timing and decision of that. But I think certainly the Abraham Accords has played into opening up potential areas where we can provide space for dialogue and discussion and de-escalate.
Okay, Ambassador, thank you very much. Thanks for spending time with us. Welcome to Bloomberg here in London. His Excellency Ambassador Mansour Abulhoul, the UAE's ambassador to the UK. Let's go from that back to a conversation about the stocks in focus this morning. Joe Easton has a briefing for us on the stocks on the move. Joe.
So ASM now down around 3%. They would be disappointed with that. They've upgraded their guidance, but the stock still falling on the context of NASDAQ futures down today, and those shares already up around 50% for the year to date. Now, I've just read a note from De Groif, the analysts over in Germany, and they say that the margins were pretty weak, and that is not as good as the revenue outlook. So that seems to be the weakness on ASM at the moment. We've also got Richemont up on the screen. Now, they are downgraded at Morgan Stanley. Morgan Stanley cuts their price targets on a number of stocks. They upgraded Prada over in Hong Kong, which they say has a better self-help potential, i.e. they will be able to reduce some of their costs. MS noting that Chinese spending is now accounting for around 75% of growth in luxury as the US and Europe weakens, and therefore they cut Richemont and upgrade Prada, as I say. In terms of Close Brothers, this is the UK bank that supplies into businesses. They don't do retail lending. It's mainly business focused, and they also have a stockbroker business. That one down 3%. Rising costs is the negative there, according to Canaccord Genuity, who recommend selling that stock this morning. We're seeing that one declining around 3%. An interesting one is TUI. This stock dropping as Gatwick Airport reduces the number of flights per week because partly due to an outbreak of COVID around one of their control towers, according to latest reports, and that's very negative for TUI. We're seeing a little bit of a negative read into EasyJet as well, but mainly TUI, given such an important base for them. Barclays is the best performing stock on the Stock 600 following that upgrade at Morgan Stanley. We mentioned the credit card business is strong, according to MS, but they also note an uptick in some investment banking deals. They cite Deal Logic data and say that is a positive for Barclays. Another read across into the rating space is also Elekta. Now, this one is upgraded over at SEB in Sweden. Elekta does radiology, and that stock has declined a lot recently. SEB says that the decline is unwarranted. Recommend buying into that one. And I've also brought up Imperial Brands on the health front, but this is obviously the tobacco maker. Now, this stock fell yesterday the most in 18 months, down around 6% at the close of trading after a report saying the UK could follow New Zealand in essentially making it illegal for certain generations to buy cigarettes, outlawing the purchase of cigarettes for future generations. That one rebounding a bit today, up around 1%. And finally, AG Bar. Now, this is a soft drink maker of everyone's favourite drink, Iron Brew, over in Scotland. This one rising 1.5%. Sales up around 30% in the last quarter. Iron Brew specifically up around 10%, according to them. And that stock rising more than 1% this morning.
Joe, thanks so much. Joe Easton from our equities team with an update on some of those stocks on the move. Coming up on the program, private equity firms are in focus. They're increasingly adding another layer of debt to their complex borrowing arrangements. So what are the risks for the broader industry? Is it time to talk once again about shadow banking? We'll discuss that next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Markets Today. We are 45 minutes into today's trading session, and European equities actually on the back foot, apart from the London FTSE 100 up by 0.2%. Elsewhere, the CAC under pressure down by 0.7, but off earlier lows. US futures also weaker, NASDAQ futures, the focus on tech weakness with interest rates going higher, with Treasury yields continuing to go a little bit higher, although, again, those off highs seen earlier on in the session. The higher interest rate environment, key to our next conversation. Private equity firms have been increasingly adding another layer of debt, some of it very expensive debt, in fact, to their complex borrowing arrangements. The moves covered in a Bloomberg Scoop story today are raising concern among some investors about potential risks to the wider industry and financial system. Let us speak to the author of the story, Bloomberg's Laura Benitez, who joins me here on set. Laura, very nice to see you this morning. So why are PE firms then borrowing more? What kind of debt are they taking on? What is this all about?
So fundraising at the minute has become really, really challenged, and just generally conditions are much tougher for private equity firms, meaning that they have to be much more creative with how they raise debt. So they're raising two types of loans, a NAV loan and a management company loan. We focused on the management company loan, which has the debt at the management company level, obviously, and that's really interesting because collateral for that type of debt is things like performance fees and essentially the management's salaries, if you like.
Okay, and what does that mean then in terms of the private equity story and the risks that we need to focus in on?
I think it's really interesting because what we're discovering is that there's much more leverage in the system than we realised. So I think for LPs, it'll be something of a challenge for them as to where they put their money in the future and where they allocate. I think, you know, for LPs, there was a bit of a stigma around this type of financing, but they're now having to kind of come to terms with it. It's a whole new world. So I think if it helps returns, they'll be kind of on board for now, at least.
And who are the lenders that are lending this money? And so I suppose we asked that question because then if there were to be any of these private equity firms that defaulted, where would the pain fall?
Exactly. It's a very lucrative business, and the biggest lenders that we know of are Carlyle and Ares, and debt financing for this type of loan is up to 19%. So the returns are very, very juicy. However, it's quite hard to reclaim that collateral in event of a default. So I think there's lots of risks there for the lenders. So we'll see how it plays out.
What does it tell us, Laura, that some of these businesses are borrowing at rates that are higher than the rates that would be applied to junk listed businesses in the United States? I mean, what does that tell us about the market's expectations for returns?
Exactly. So, I mean, these rates go from like low teens to high teens, like up to 19%. They're pretty eye-watering numbers. So I think it just shows you where, expectations are settling in at. But these are very risky loans in some cases, so it's priced accordingly. The risk has been baked in.
And what about concerns around the broader financial system? So clearly there might be concerns around individual businesses, whether they take on too much debt. Always your mind goes to just how systemic this could end up being. I mean, we've seen more, the private debt markets doing more and more. And I wonder whether we need to keep an eye on them with regard to financial stability?
Absolutely. And these deal sizes for things like NAV loans and management company loans, they're getting bigger and bigger. So we had a story out a few weeks ago about Apollo having $4 billion in the pipeline, and that was for 4 deals. Each deal was $1 billion each. These are very huge transactions. So we definitely need to keep an eye on how systemic it is and how many borrowers are actually taking on this debt. We think it's many, but we're still in early stages of reporting. So.
Yeah, I mean, sticking plaster, is that what this is, this borrowing over businesses that are really struggling with higher interest rates?
It's interesting you said that, because we spoke to someone yesterday who said it's like an energy drink. It's like Red Bull. It gives you that instant boost, but you do come crashing down eventually. But we'll see if that it plays out or not, or whether it's more subtle.
Yeah, maybe the time is all that is needed, but depends how much time you get. Laura, thanks so much. Thanks for joining us. Bloomberg's Laura Benitez with that really fascinating deep dive story into private equity piling on the debt. You can find more on that on the Bloomberg terminal and on the Bloomberg website. Coming up on the programme, we'll be back to the market moves. Minneapolis Fed President Neil Kashkari says he expects one more rate hike this year. We will get more on the Fed conversation. That's coming up shortly. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
This is Bloomberg.
We have both the issue of the level and the issue of the length of time, which are two big considerations for the monetary policy decision that we debated at length at our last monetary policy meeting, and which led us to decide to increase by 25 basis points all three rates. So, and every portion of that paragraph matters. It starts with, based on our current assessment. I pause. If there are no other significant shock and the current assessment holds, I park that. We consider that the key ECB interest rates have reached levels. Here we go. 4%. That's what was decided. Comma, maintained for a sufficiently long duration. That's the length of time during which it has to hold, to be held. will make a substantial contribution. This is not sort of run-of-the-mill, business as usual kind of wording in a monetary policy statement of the beginning of the paragraph. Then we continue. We will continue to follow a data-dependent approach to determining the appropriate level and duration. Yet again, the two components come together. In particular, our interest rate decision will be based, and that's the usual wording that you always now find in our statements, on our assessment of inflation outlook in light of the incoming economic and financial data. 2, the dynamics of underlying inflation. 3, the strength of monetary policy transmission.
The European Parliament there being schooled in communications by the ECB President Christine Lagarde, speaking to them in Brussels on Monday, giving her, well, adding extra detail, I suppose, around why the central bank communicates in the way it does and what it has and has not said to the markets. Let's talk about the rates environment with Justina Lee, our cross-asset markets reporter, who joins me on set here in London this morning. Justina, a great day to talk to you because yesterday, of course, we saw substantial moves, in particular at the very long end, in treasuries, driven by treasuries, but also coming here into Europe as a dynamic. Today we see bond markets running once again with that theme. We had seen, in fact, just a few moments ago, we've seen treasury yields continuing to climb. How much longer do we talk about this story, do you think, Justina?
Yeah, it feels like investors are finally digesting the reality that maybe rates will be higher for much longer. I mean, you have Fed officials, Neil Kashkari being the latest one, hammering in the message that the Fed might even hike rates again. And of course, you have Jamie Dimon talking about 7%. And I think here, the debate in markets is probably, have the markets sufficiently adjusted to this new reality, and will it then next move on to kind of pricing in economic weakness? And I think that's especially the question in Europe, given we've already seen data head that direction.
Yeah, and it goes back to what Christine Lagarde was saying there about the level we get to and then how long we stay there, the level and the duration, as she said a number of times. China, also a big headache hanging over risk appetite. You see that in Europe. You certainly saw it in the Asia session overnight. What strikes you as interesting about the latest developments around China then, Justina?
Yeah, it's funny because it's coming at a time when a lot of the economic data in China are actually turning better. And of course, you've had that raft of support measure for the property sector. But I think what we're getting, from this kind of all this bad news about Evergrande and a lot of other property developers is that these structural issues run a lot deeper. And I think investors are increasingly skeptical that the support measures we've seen so far are enough to prop it up, because a lot of, real estate investors in China are going to look at that news and wondering, are prices going to fall further? Should they buy later? Yeah.
Justina, lots to think about. Justina Lee, our cross-asset markets reporter, thank you very much for joining us. European equity markets on the back foot. The FTSE 100 just making its way into positive territory. Things on the move in fixed income markets. So we had seen a continuation of yesterday's theme of higher yields this morning. That's just on pause though now. I see the UK 2-year, we're seeing some buying at that end and the Treasury's conversation changing. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And You know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
And market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacroix. Here's what's coming up on today's program. Shares in Europe retreat for a fourth straight day as 10-year Treasury yields hit their highest level in 16 years. Now, the crisis at Evergrande deepens after its mainland unit defaults on a 4 billion yuan bond. Shares in China extend their declines. Plus, the EU's trade chief warning China that its position on Ukraine is hurting trade as Beijing calls for caution from Brussels over EV subsidies. Now let's take a quick look at the European markets map here, because again, like I said, broad weakness here coming a lot from Asia, actually. Take a look at this. A lot of the red that you are seeing really concentrated here in France, where you see the CAC 40 almost down 1% there. And also look at some headlines out of Germany as well, cutting planned fourth quarter federal debt issuance by about 31 billion euros. A quick check on the German markets there. The DAX down by about 0.6%. Slight outperformance by the UK. You can see the FTSE 100 unchanged. I guess that's success on a day when you see a sea of red. But that's certainly something we're going to be watching in the equity space. Let's get to the bond market, though, because, of course, overnight in the U.S. and Asia session, that is where your biggest move occurred, to the point that you have now seen the 530s curve actually break above zero. This is important because it means that there are now going to be some interesting dynamics in the bond market specifically that might just indicate that perhaps we are on recession watch yet again, even though we keep hearing the word resilience in the conversation for the global economy. Joe Davis joins me in just a moment to talk about what this all means. At the same time, a key watch in Asia right now when it comes to the FX space. You are seeing dollar-yen move quite a bit. The anticipation here is what number is too far, especially when it comes to the technicals. Dollar-yen hitting, at least they're testing, I should say, that 150 level. Does this at the end of the day mean some sort of currency intervention? Now remember, currency intervention does require the help and the consensus of some of the other major economies in the world. This is not a BOJ decision by itself, but is this something that we see in the coming days? Which again, brings it back to the real core issue, inflation. And at the core of inflation, commodities. And that's where another thing I want to bring to your kind of topic list, if you will, here, your agenda, is what's going on in the oil market. We're talking about a $100 watch for Brent crude. Well, watch the stockpiles as well, because here's where the pressure is building up. The physical market is getting tighter and tighter. Well, over in Oklahoma, those crude stockpiles also getting tighter and tighter. And that's where you're starting to see upward pressure on that price story. And that's going to be something we talk about in terms of all of the cross-asset dynamics that you start to see. Who better to talk about it with me than Joe Davis, Vanguard's global chief economist and head of investment strategy group, joining me right here on set. Yeah. Took a trip just to see me. Isn't that amazing? Look, Joe, let's start with the inflation story here. Yeah. As we're talking about Brent crude hitting $100 a barrel, Jamie Dimon had a really fun headline saying 7% might be on the agenda. What's reasonable here?
Well, I think, again, we have these cross currents. I mean, Credit, and again, thanks for having me. Inflation has been coming down, but I think what has been competing with that is this desire of the financial markets for central banks to start cutting rates. And so, which opens the door to the very inflation risk that led to the raising of rates to begin with. So again, that's been the misplaced narrative in the markets. And so I think I've been very encouraged to see the market starting to come to the reality you were just mentioning of higher for longer. That was our outlook for over a year. And so that ultimately will carry the day.
When you're talking about higher for longer, though, what does that look like? Because I remember, I'm old enough to remember when a 5% terminal rate in the U.S. for the Federal Reserve was the contrarian call of the market.
Yes.
Then we are getting closer and closer to 6, now potentially 7. Talk to us about Jamie Dimon's call here. Is he even remotely right about the upward pressure?
Well, 7% would be possible, but I think we have to be a little cautious of momentum. I mean, when I got into the business over 20 years ago, 5% was quote unquote normal. And I think what our thesis has been for some time, Curdy, was that the past 10 or 15 years were more the exception rather than the rule. Bond market was slow to embrace that we're actually going to be higher for longer. So rates were low and persistent, but persistence does not mean permanence. And so 5% is a little restrictive, but it's not like the restriction we would have thought of just 10 years ago. And so I think that is reality. 7% would be possible, but that would have to be, we are underestimating growth. We're underestimating a bring back of inflation. So is that possible? Sure, but I would characterize that still more as a tail risk. And this is coming from a firm that had 5% as a more baseline expectation for over a year.
So what does that then do in terms of this bond market? Because it feels like the fact that we're even talking about the resilience breaking down or 7% even re-entering the conversation is kind of had the bond market on its head. What is this bond market telling you?
Well, I think it's getting more balanced. I mean, I think I've been very encouraged. In fact, we said Vanguard bonds are back. We have real positive interest rates, meaning over and above the rate of inflation, which has been the exception for some time, right? So that's a very positive environment. You're starting to see, another theme I would say is boil the frog. We've had to see the long end of the curve start selling off as it bakes in a little bit more of this higher for longer perspective. I think we're closer to the end than the beginning of that. And again, this is coming from having said that for some time. So I think we're a more reasonable environment. The short end of the curve is obviously very high. Is the Federal Reserve and other central banks done? I think they're close to it, but if you push me, they probably have one more hike in them.
Interesting. Sharing the view of Neil Kashkari overnight as well. Let's talk a little bit about the comment you just made. Bonds are back. Why are they back, though? Especially if we're talking about this resilience breaking down at some point, cuts coming down, that yield that was so juicy. How juicy does it stay?
Well, again, that there's ups and downs over what the neutral rate is. So that gets into that wonkish debate that no one knows exactly what it is, but it is not what it was pre-COVID. And so that means the risk-free rate is higher than what generally has been the past 10 years. So, Curdy, that means that's positive over and above the rate of inflation. Again, it wasn't that long ago when there was a concern of secular stagnation. Most bond markets had zero negative interest rates. So I think this is the best financial development in at least 15 years. And that's, I think, what we're starting to see in the bond market.
So that's all the U.S. story.
Yeah.
We're going to talk for days about that.
Sure.
Let's talk a little bit about Europe here, because the resilience story does not apply when you look at Europe. We just got that headline that they're planning to cut, Germany specifically, planning to cut that fourth quarter federal debt issuance by about 31 billion euros. What's the read-through? What does it mean?
Well, again, I think that's where we're seeing the differences between, say, the U.S. and I'd say even part of the U.K. and Europe, right? I mean, you have to look at monetary and fiscal policy together. And in Europe, it's more of they're modestly restrictive. You just saw the headlines with Germany. They're certainly not adding to the national debt in significant magnitude. So, if it's not hurting, it's not working. And so collectively, you look at both policies, they're both restrictive, which is why we're seeing greater weakness in Europe, less so in the UK, although that's starting to become in the pipeline. And then a distant third is the U.S. That's because fiscal policy is almost offsetting some of the monetary. And so you have to look through both those prisms to get a better picture on the growth picture.
Well, look, you said that word fiscal policy, and this is something this is what keeps me up at night, Joe. If I was president, which to me is the equivalent of like queen of the world, what powers do I have in my toolkit to actually hit inflation in a way that benefits the U.S. economy? And arguably, I think this conversation applies to Europeans and Asians as well, which is simply this idea that currency intervention is on the list. Subsidies to sectors that are that impact inflation, things like farming, things like oil sector for the United States. Where is the fiscal policy in the U.S. and arguably in Europe as well in terms of the monetary mandate to tackle inflation?
Well, again, you know, we're in a part where if you have higher interest rate environment, it becomes counterproductive given a high debt level. It only starts the compounding process. We saw that from the Congressional Budget Office, some of their updated projections. So if you want to be queen for a day, president for a day, I think what I would be urging as counsel, it would be to say, listen, near term, you can have budgets go out of whack because of COVID, unfortunate recession, and so forth. Take the long-term view and just reduce the gap between tax revenue and government spending. It sounds so simple, but that requires a lot of political will, regardless of what the economy or government we're talking about. So long-term sustainability actually has a huge dividend, and you would actually see bond markets reward you.
Yeah.
So I think we're starting to enter a period in the next several years where there's going to be increased skepticism of that long-term fiscal sustainability. I'm not being alarmist. I'm just saying I think that's a more just, you know, obvious reality.
So this is why I'm not queen for the day, clearly. Let's talk a little bit about the trade.
Yeah.
We'll get to Asia in a moment, but in terms of the U.S. and Europe, what's the trade?
Well, I think in European side, it's actually you got valuations as a tailwind. You know, and I'm coming here from the United States, just got off the plane, and where technology still is rapidly above any fair value. And so I'm thinking that perspective is fixed income is attractive on a real inflation-adjusted basis. And then from the equity side, you want to be invested, but the U.S. expected equity premium is pretty small. And so going overseas, which again has not worked out the past decade, but at some point valuations matter.
Well, that cyclical trade, certainly not a global one at the time. Bonds are back. That's the view from Joe Davis, the Vanguard chief global economist and head of investment strategy group. Well, lucky for us, he stays with us. Stick with us. We're going to go from U.S. and Europe to the Asian story. Coming up, Chinese property developer Evergrande's mainland unit has failed to repay an onshore bond while former executives are reportedly in detention. We'll bring you the details next. This is Bloomberg.
The IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The The conversations that matter and the insights that you need. This is The Pulse. I'm Kriti Gupta in London. The Evergrande crisis is worsening today as the company's mainland unit failed to repay a 4 billion yuan onshore bond. Meanwhile, state media reported yesterday that a former CEO and former CFO have both been detained by Chinese authorities. For more, let's go to Bloomberg's Kevin Kingsbury in Hong Kong. Kevin, just how bad can this get from here?
Well, that's kind of the million-dollar question here. We have, like you said, the new news overnight that two executives, former executives, had been detained. These two executives had left the company in mid-2022 amid a scandal related to 2 billion yuan of securities that were taken from deposits and used to help finance or help guarantee some loans. So it seems as though after the defaults that we have been talking about, now we have an onshore default. The creditor votes regarding its offshore debt restructuring plan were canceled over the weekend. So it just seems as though we have good after bad just kind of piling up here for Evergrande.
And at the same time, it's coming with a backdrop of this weakness in the yuan. Talk to us a little bit about the policy efforts here. How much is the expectation that they're going to step in and take over?
Well, folks have been thinking for some time that at some point China has to come in and kind of help save this property sector, but they just haven't so far. We even seen with the mortgage limitations that were eased early this month, we did see a brief bump in sales, but things have petered anew over the last few weeks. We'll get some new data late in the week to kind of really get a sense as to how September home sales were. And if they were continuing to struggle, it doesn't make it good for the upcoming Golden Week holiday, which has always been a key period for new home sales in China.
Certainly a lot to watch as well. And we continue to see that weakness in Asia that for some reason isn't actually spreading to the rest of the world. Bloomberg's Kevin Kingsbury in Hong Kong. Thank you for the update on this program. Still with us, Joe Davis, Vanguard's global chief economist and head of the investment strategy group, joins me right here on set. Joe, as I just told Kevin, the situation's getting worse. You're seeing it reflected in the Asian markets. Why does nobody else care?
Good question. Again, we have an area that for years some have worried about, overcapacity, overbuilding. That's been the theme for China for some time, and so I think there's a point with which it will matter. I think what the market is assuming is that this is idiosyncratic, which a fancy way for saying there's not more bad news coming. I think that would be a little bit naive, and so I think again, I think what we're going to see next year, Kriti, is going to be this debate of, and in fact you referenced it, when do Chinese officials step in, because you have some of the hallmarks of parts of what we saw in the global financial crisis in 2007, 2008. Again, different, but similar in terms of is how much more to come.
So what does contagion actually look like here? Like what actually is the read-through into property sectors in perhaps Germany, in Sweden, in the U.S.? Is there one, or are these just isolated issues?
Well, again, it's different than, because you have obviously, the capital account and current account's not fully open in China, and so you're not going to have that sort of parallel or corollary. I mean, you're just going to have a general multiplier on economic activity, the construction base, those sort of multipliers. Again, I think what the debate's going to be is how China officials certainly want to see some failure because of the overcapacity. I think where they're going to have an internal debate, my guess, is how much do you let that play out, because they were also very critical of the quote-unquote bailouts we saw in some Western economies, 2008, 2009, 2010. So that's going to be the debate, not right now, but it's going to be the debate next year.
So you said the multiplier effect is really what you're paying attention to. What is that multiplier?
Well, it's significant. It can be as high as 1. I mean, you're talking about commodity-intensive building. Obviously, I think what's different, which is why, we're still a little bit more pessimistic on growth, Kriti, for the next 6 to 12 months. China was a counter-cyclical play to the Western markets for over 15 years, right? When the West, Europe, and the U.S. were weaker, you would have China stimulate or grow. We saw it in 2011. We certainly saw it in 2008. Different dynamic this time, and so I think that's a headline that I think, to your question, I think is underestimated by the markets for the next several months.
Well, specifically the commodity markets, because if we're talking about this commodity-intensive dynamic that's really losing a lot of its momentum, for lack of a better term, why are oil prices still at near $100 a barrel? Why is copper still kind of holding its own? And I think the dislocation you're pointing to in the commodity space is pretty fair. Where else is that being mispriced?
Well, I think, again, there's the supply, right? So at the same time, we just clearly don't have enough supply in the commodity markets. And so I think that's the battle, right? At the end of the day, the demand forces will take over. But we've seen in the United States with the inventory levels. That was, the story before you came on the air. So that's going to be the duality. Obviously, China is going to have depressant force. They have whiffs of deflation. But again, we've seen this story play out in the inverse when we had a disinflation problem in the U.S. and Europe when China was at the opposite. So this is not unusual to have these cross currents.
When we're talking about the cross currents, though, where does monetary policy then kick into that? Because it feels like, we've been talking about this for 2-3 years now, right? Every region of the world is in this kind of late cycle phase, for lack of a better term. When does that end? Where is your recession call?
Well, I think, again, we go into next year. Again, in the U.S., what I think, if anything, we underestimated was some of the fiscal offset to the monetary policy. Europe, it's generally been on point. UK, generally on point. Maybe a little underestimated just on the inflation of the past 6 months. So, but when push comes to shove, the markets that are strongest, monetary policy has not been restrictive enough and hasn't been restrictive long enough. So I think it's naive to expect immediate fall off. So it pushes us into next year. I don't get concerned about deep downturns, but the thing that keeps bearing in mind is let's keep an eye on China because that would be a headwind at the same time that you have Western economies decelerate.
30 seconds here. How quickly does that late 2024 call that you're making on recession get fast forwarded?
Well, I think it will be fast forwarded, the longer that central banks keep it up. The only thing that could forestall it, which would open the door for other risks, is if they somehow cut rates, but that would be the mistake.
Well, let's see if they make that mistake, if they will. Joe Davis, Vanguard's global chief economist and head of investment strategy group, we thank you for joining us. He's great. He brings us the economics, the market calls, all wrapped up into one package. Coming up on the program, Airbus orders take off. Air France renewing its long-haul fleet. Details on the deal coming up next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
On the next episode of Hello World, I head to Los Angeles, meet some robots. Then eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World, Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, Airbus just got a leg up over its arch rival Boeing, all thanks to a massive new order. Air France KLM is renewing its long-haul fleet with an order for 50 Airbus A350s. And on top of that, purchase rights for 40 additional aircrafts. Now, the order will make Air France KLM the single biggest operator of the jet. For more, let's go to Bloomberg's Benedict Camel for a little bit more context. Benedict, walk us through the logic here.
Good morning from Berlin. So this came out last night, and it was the culmination of 7 months of really intensive negotiations. We knew that Air France KLM needed to renew its long-haul fleet. They had some older Airbus and Boeing planes in their books that they were starting to get rid of, so they really needed new planes here. And it was, as we heard from the CEO, a real sort of back and forth between Airbus and Boeing, and it came down to the wire. Ultimately, Airbus won out. They won a sort of winner-takes-it-all contest here. 50 planes, as you said, potentially almost doubling that to 90 if they exercise their purchase rights. And so we hear from the company that they thought the factors that played into this were range, for instance. That was an important factor that played into Airbus's hands. It was price. It was also something like, you know, the availability of the plane, who was able to supply them sooner rather than the other one. So all these factors combined gave Airbus the leg up.
30 seconds, Benedict. In terms of long-distance travel, is this a positive sign? 30 seconds.
Absolutely, yes. This is a good sign. Long-distance travel is back. Airlines are trying to cut back on their fuel bills. This will help them. There is the issue of Russia. A lot of airlines have to fly around Russia. But again, this type of plane will help Air France do that. So this is a strong signal into the market that long-haul travel is back and companies are investing.
Benedict Camel leading our Bloomberg Global Aviation team with the crucial context on this deal. Thank you for joining the program. We, of course, will be speaking to the CEO of Air France KLM later in the week. He is joining me right here on the show. Don't miss that exclusive interview Friday at 9:15 a.m. London time. Now, coming up on the program today, Moody's, the only remaining major credit agency to assign the U.S. a top rating, has signaled that its confidence is wavering ahead of a potential government shutdown. We'll be joined by Alex Brazier, Managing Director and Deputy Head of BlackRock's Investment Institute. Stick with us. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Now, shares in Europe retreat for a fourth day as 10-year Treasury yields hit their highest level in 16 years. Now, the crisis at Evergrande deepens after its mainland unit defaults on a 4 billion yuan bond, shares in China extending their declines. Plus, the EU's trade chief warning China, that its position on Ukraine is hurting trade as Beijing calls for caution from Brussels over EV subsidies. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Now, the Federal Reserve Bank of Minneapolis President Neel Kashkari says the U.S. needs to get back to the Fed's 2% inflation target. He also gave his take on the Fed's rate path in the battle to tame inflation. Take a listen.
There's a lot of uncertainty about where we are in terms of how tight is monetary policy right now. And so that's why, if you look at the SEP, the forecast, or the projection rather, we have a majority of participants have us raising rates one more time this year. I'm one of those folks who has that. But basically, we're going to take our time, see what happens to inflation before determining how high we need to go.
So that's the monetary side of things. And you got to talk about the fiscal side of things. Moody's, the only remaining major credit grader to assign the U.S. a top rating, has signaled that its confidence is wavering ahead of a potential government shutdown. Are we going to see a repeat of 2011 when investors basically piled into the bond market off the back of that U.S. downgrade? Well, let's ask a true expert. Alex Brazier, Managing Director and Deputy Head of BlackRock's Investment Institute, joins me right here on set. Alex, that question to you. This all feels pretty doomsday. We talk about the U.S. shutdown every couple of months around the world. But this one time, it feels real, simply because of that warning from Moody's. Do we then see the bond market get a bid off sheer panic?
Not because of the shutdown, I think. So this shutdown, very different to the debt ceiling episode of a few months back. But what we're getting here is sort of repeated bumps in the road. But step back, the bigger issue is actually the US fiscal position. So we're in an environment where the US is running a large, by historic standards, primary deficit. Interest rates have reached, as you said, 16-year highs. And trend growth, in our view, in the United States, as in many other advanced economies, is weakened. Now, that adds up to a very difficult fiscal position, and a position in which, over coming years, the US government will be issuing increasing amounts of debt. And to us, that makes it quite surprising that, even though yields have come up a lot, there's still no real term premium in the US bond market. So we see real opportunities at the short end, but the repricing reflects monetary policy rather than any of these broader fiscal issues. So I think a focus on some of these shutdown issues is sometimes distracting people from the broader issue that you see when you step back about the U.S. fiscal position.
Well, when you're talking about the U.S. fiscal position, I mean, what even remedies that? Because then you're talking about the volatility, sure, right now for a government shutdown, but going into 2024, a lot of political volatility. We're going to get into the situation once again, and then once we find out who's president, I think 6 weeks later, we hit the debt ceiling again in January of 2025. So the calendar is not on our side. In terms of the trade, how worried should we be that the bid for bonds is going to be met with digestion issues, supply issues?
Some degree of worry, yes. I mean, we've got three things going on. We've got the US fiscal position, we've got the Federal Reserve moving from quantitative easing to quantitative tightening, and we've got just generally a more volatile interest rate environment in this regime because the Fed, as we heard from Neel Kashkari there, is trying to squeeze down inflation with restrictive policy. All of those three ingredients should add up to some form of term premium. in US long-dated bonds, but it hasn't yet. And that makes us favor the short end in the US. Now, you look at other bond markets, actually it's quite striking to compare what's happened in Europe and the UK. Yields are up, if you compare to pre-pandemic levels, much more here on this side of the Atlantic than they are in the US. So there's much more compensation for some term premium, for interest rates staying higher for longer. And we see real opportunities now to lean into that longer end in Europe and the UK as well.
Term premium feels like the new real yield, if you will.
Yeah.
Alex, talk to us a little bit about what market, the ones that you just laid out, the UK, the EU, well, gilts, boons by extension, the Treasury market, we'll throw JGBs in there as well. Which market has the biggest liquidity problem right now?
That's difficult to say. I mean, it's probably a mixture of all of them, and they've all got different features
You have to pick
going
one,
on.
Alex.
I'm going to pick the US Treasury market as the one where the risks are not priced.
Okay.
I think some of the other markets, the risks are better priced. But for example, we've seen recently regulators highlight the leverage trades, basis trades in the US Treasury market that caused some volatility back in 2020. So there are kind of plumbing issues. And as banks have stepped back, those plumbing issues become more important over the years. And again, with no term premium priced, you have to question whether that volatility at the long end that we expect to see down the road is really fully reflected.
What impacts that volatility? Because when we're talking about kind of cross-asset correlations, there was a moment where it was so clear that commodity-driven inflation was the easiest kind of sure thing in the market. So basically what you did is you shorted bonds and you bought a basket of commodities, and that was your trade for a year, and it worked out just fine. That correlation between bonds and oil feels broken lately. Do you see that reconverging?
No, and I think, take a step back, this is our view that we're in this new regime. And I think the defining feature of this new regime is central banks going from, if you like, looking through energy-driven inflation to trying to squeeze down inflation all the time. And why is that? Well, it's because economies are facing many more supply constraints. Since the pandemic started, we've got reduced labor supply growth in the US and in Europe. We've got reduced productivity growth in Europe and the UK. And all of that is making it more challenging for central banks. It means they're having to hold rates tighter for longer, which the market is now coming to terms with. And that changes all sorts of pieces of the correlation structure in markets.
You say that the U.S. has a productivity issue. I think there's a lot of productivity issues post-COVID around the world, to be completely honest. Larry Fink himself had said that one of the solutions to productivity is AI, and that might be the acceleration of it might actually help with the productivity issues and show up in the data, maybe not immediately, but in the years to come, something that could, and this is just me adding my own editorial, potentially could fuel the equity market, and you're already seeing that for years to come. Your take on whether the bond market should be pricing in a structural change like that?
Yeah, well, so first of all, maybe I misspoke, but I don't think the US has a productivity problem.
Oh, okay.
I think Europe and the UK have more of a productivity problem. I think in the US, the issue is much more about labor supply. And what we've seen, if you look through the pandemic, is that trend growth has shifted down in the United States. And that's why, over the period since the pandemic, the Federal Reserve has had to squeeze down activity. In our view, the US economy is basically stagnated for 18 months. And that's because it's done so under the weight of the Fed's rate hikes. And the Fed had to do that in order to bring levels of activity in line with their new lower potential trend. Now, same's happening in Europe, just for different reasons. Could we see an acceleration of that trend in future? Possibly, as a result of things like AI and tech. But the key thing is that for now, the US is on this lower trend growth path. But many equities, there's a challenging environment for equities, are kind of reliant on an acceleration of growth at some point down the road. The difference between earnings multiples and real rates now, obviously very stark. But there are opportunities within equities because there's a lot of dispersion.
Yeah, I mean, again, I think it's not as clear of an investment picture, so I certainly don't envy your role at all, but we certainly appreciate your insights this morning. That, of course, is Alex Brazier, Managing Director and Deputy Head of BlackRock's Investment Institute, joining me right here on set. Now, coming up, we go into the geopolitics of it all. The EU trade chief warning that China's stance on Ukraine is hurting trade. The latest from Valdis Dombrovskis and his trip to Beijing. That conversation next. This is Bloomberg.
and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Our mission, our duty is to return inflation back to target in a timely manner. The faster it gets there, the more stable prices are, the less painful it will be going forward for both those who invest, but also those who have borrowed.
ECB President Christine Lagarde, they're repeating that borrowing costs will remain elevated for as long as needed to tame consumer prices. But she didn't specify just how long that period would be. Now, at the same time, you have the geopolitics of it all. The EU's chief trade negotiator's 4-day trip to China has wrapped up with a press briefing alongside China's vice premier, where the two traded words over economic relations. Take a listen.
We hope that the EU would exercise caution and to continue to keep its market free and open. This benefits European consumers, benefits green and local development of Europe, and benefits global climate change cooperation.
The EU is having a trade deficit with China of almost 400 billion euros. And European companies in China are raising a number of concerns about business environment. Addressing these concerns would help China to retain its capacity to attract and retain foreign investment and meets its objective of a sustainable, high-quality economic development.
Bloomberg's Jill Deese has joined the program for more. Because, Jill, on the one hand, you have monetary policy kind of seeing a little hazy, for lack of a better term. And then you have this, geopolitics, also hazy as well. Let's start off with the geopolitics. Is this the start of a new China doctrine when it comes to Europe's approach to the East?
Well, Kriti, I think what was really interesting about this trip that Dombrovskis took is that traditionally what you see with these trade chiefs, these economic figures, when they make these trips, and they kind of want to divorce some of the geopolitical elements from a lot of the trade elements. You've seen that kind of form this compromise, kind of work around those issues. That's not really what Dombrovskis did on this trip at all. As you saw there, he was just talking about a lot of investability concerns among European businesses and existing consumers in China. But also a big part of his speech sort of revolved around hitting on China for its position on Russia's war in Ukraine, sort of its continued support, at least from a diplomatic perspective, for Moscow. And he talked a lot about how that's actually hurting China's image. And I think that was just really stronger comments than maybe we've seen from this type of representative, this trade representative from Europe coming into China. I think that it does indicate at least some level of really putting the pressure on China here.
And that's just the EU side. Now talk about how China's actually feeling about it. You mentioned the pressure there. What have they actually said? How are they responding?
Well, with that press conference there, where you're seeing Vice Premier He Lifeng, so that's essentially Dombrovskis' counterpart there in China, talking a bit about how disappointed that China is in particularly the recent electric vehicle probe, subsidy probe that Europe launched into China. That was sort of a precursor for this visit, really heightening tensions. We saw some actually really strong language that China's Commerce Ministry had put out about that probe just about a week ago, when they were talking about how it was the sign of protectionism. They actually say that overall, China's attitude here, their rhetoric hasn't been as strong as, say, what they have said about a lot of the U.S.-based curbs, export curbs and stuff like that on China. But still, I mean, they're obviously sort of pushing back here. It's really interesting to see all of this unfold when, the broader scope for this entire arrangement here with Dombrovskis visiting China is them, signing agreements or trying to find points of cooperation.
I mean, it's a crucial standpoint, and I think Ian Bremmer over at Eurasia Group had made the point that Europe in the kind of U.S. and China standoff had been caught in the middle and was almost encouraged to take a stand, which they are very clearly doing through things like EV probes. We go there next. For now, Bloomberg Still D says thank you for that crucial insight. And as promised, again, the EVs story seems to be the perfect kind of continuation, for lack of a term, the perfect segue for that theme. The EU's probe into Beijing's EV subsidies is meant to protect its car makers from a flood of cheap Chinese cars. But it could end up hurting the likes of Mercedes-Benz and BMW, where China is their biggest moneymaker. Let's get more on the story with Bloomberg's Oliver Crook. Oliver, you're seeing some real divergence between European policymakers and then German automakers. What can you tell us about it?
Right, exactly. I mean, if this is exposing the rift between China and the EU, it also exposes some of the more minor rifts within the EU itself. We understand that this was pushed for really by France, and you can understand why. They do about 90 billion euros worth of trade with China last year. Germany did 300 billion. And when you look at the car makers, it's even more exaggerated. Renault only gets about 6% of its revenues from Asia Pacific. For the big three in Germany, it's more than a third of the volume that they do. Now, they have some joint ventures over in China, which means that those would be spared from tariffs under this scenario. However, the super high margin cars, the Porsches, the Maybachs, S-Classes, 7 Series, those ones are assembled, many of them here in Germany and in Europe, and then shipped over. So if you get some tariffs and some trade barriers coming up, it's going to hit those profit centers of those extremely high margin, extremely expensive cars.
And at the same time, we're not just talking about tariffs when China and the EU, the UK, also a factor there. Why do we pay attention to the EV story here in the UK? This is spilling over all over the place. Basically, if nothing happens by the end of the year, you're going to get 10% tariffs on EVs that go across the channel. Why? They have these rules of origin rules that are going to come into power at the end of the year if they don't change anything, which means that if 45% of the value of your car was not produced in either the EU or the UK, it gets slapped with a 10% tariff. Now, the problem is EVs, most of the cost of an EV is a battery, and no one's really producing batteries on that kind of volume in Europe. So these things will automatically get hit. So the EU is saying we don't want to change the rules because we think that this will delay getting supply chains and batteries in order. The UK and the auto industry are saying, listen, it's already hard enough for us to make this transition. The last thing we need is some more self-imposed hurdles. So the negotiators are going to be speaking today on the EU and the UK side to try to delay this for 3 years or not, and that's going to be the debate. Well, let's stick with the car theme here because, of course, this is going to hit a lot of the European car makers, but there's one that seems to be taking a bigger hit than others, Stellantis, specifically off headlines coming out in the U.S. where Biden is officially heading to the picket line in Michigan. Who does this help more, the union's negotiators or Biden's reelection?
I think it can help basically both of them. I mean, having the support of the president certainly is helpful to the union, and for the union, for Biden, it's going to be very helpful as well. I mean, this is really an act without precedent in recent history, in at least 100 years of a sitting president to go and go to the picket line. And, part of the issue here is that, that politically speaking, unions are very favorable in American public opinion. American public opinion, basically 71% are in favor of unions now. That's the highest since 1965, according to the Gallup poll on that fairly recently. So in 2020, the UAW backed Biden. They have withheld their recommendation and their endorsement so far, saying he really has got to earn it. But we understand the UAW president will stand alongside him on the picket line. So that is certainly a sign of a certain kind. And Trump, of course, goes on Wednesday. He's going to give his speech in Detroit, trying to speak to the same audience. And these are absolutely crucial states for re-election. Michigan, Pennsylvania, Wisconsin, these can really make or break elections. So everyone is going to try to get this vote.
And that UAW endorsement still for the taking. Bloomberg's Oliver Cook, thank you for walking us through this story. Elsewhere in the electric vehicle market, South Korea's LG Electronics is turning to EVs to help drive their growth. Now, the tech giant is aiming for $17 billion in annual sales from its so-called vehicle solutions business by the end of the decade. LG Electronics CEO William Cho spoke exclusively to Bloomberg.
Vehicle solutions business is a growth engine for LG Electronics now, and has been growing at an average growth rate of 30% over the past decade. And it accounts for 14% of total revenue in the first half of this year. And our current, the order backlog is expected to reach out $80 billion by the end of this year.
And here's a look at some of the other stories we're following today from around the world, starting in Ukraine. Their military says its troops have made advances along the southern front line against entrenched Russian defenses. This comes as U.S. battle tanks arrive to bolster the 4-month-old counteroffensive. The Institute for the Study of War called it a, quote, tactical breakthrough, though it said the situation does remain fluid. Over in the Middle East, Saudi Arabia took a key step towards advancing its nascent nuclear power program, telling international inspectors that they'll have wider access to Saudi facilities. Now, the move means that Saudi will be able to access supplies of fissile material and begin operating its very first reactor. The de facto Saudi ruler, known as MBS, has repeatedly warned that his country would have no choice but to enrich its own nuclear materials if its rival Iran is allowed to continue doing so. He's also warned that if Iran develops a nuclear bomb, Saudi Arabia could look to do the same. Coming up on the program, we bring the story back to Europe. Steep odds in Spain. Opposition leader Alberto Núñez Feijóo mounts a final challenge to become prime minister. We're live in Madrid with the latest next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
After Spain's inconclusive elections in July, the country's center-right opposition leader, Alberto Núñez Feijóo, is making a final attempt to stretch the parliamentary math in his favor. Let's get the latest with Bloomberg's Rodrigo Orihuela. Rodrigo, he's making the case to lawmakers today to be elected. Is that going to work out?
It seems highly unlikely. He is 4 lawmakers short of the number he needs, which is 176, an absolute majority, more than half of the chamber. However, because of the complex dynamics in Spain, where regional parties with regional nationalisms are very strong and have a presence in parliament, it seems unlikely he'll be able to put these people on board with him, given that he has already a coalition with Vox, the far-right party, which is really against regional nationalisms. So it seems like he is headed for a defeat in the vote tomorrow and in a second vote, which he is likely to face on Friday.
So what actually happens if he doesn't get elected?
So, as I said, he has a vote tomorrow where he needs an absolute majority, more than half of the chamber, and then on Friday he has a second chance where he needs more yeses than nos, so you could have abstentions in theory. Now, if he doesn't get elected on Friday, what happens is that there is 2 months in which another candidate can try to be elected, and in this scenario, it seems that will be caretaker Prime Minister Pedro Sanchez, who will try to do it as well. But also, Pedro Sanchez also has a problem with maths. He's not quite there yet as far as the majority goes.
I mean, it's something that's really crucial as well as we kind of watch the developments coming out of here. This is going to be a multi-day story. Rodrigo Orihuela in Madrid walking us through that. We thank you for joining the program. Of course, it's going to have an impact as well on the geopolitics, but specifically the markets. We're already seeing a little bit of movement, specifically in the German 10-year. You're seeing those real yields headed for a 10-year high. Remember, a lot of cross currents the next couple of days. We've got the French budget coming up as well, in addition to, of course, the continuing geopolitics story between Europe and China as well. Right now, again, those 10-year real yields headed for a 10-year high. What does that do to the valuations of the growing European stock market? I'm sure everything will be hit in the hours ahead. For now, Bloomberg Brief, Danny Berger in London, Manus Cranny in New York. Take it from here. This is Bloomberg.
Strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I mean, I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Traders recalibrate the path ahead. The bond sell-off pauses as yields hit multi-year highs. Even higher for longer. Jamie Dimon says the world isn't ready for 7% rates, while Neil Kashkari says the Fed needs to hike again. And as negotiations near a deal to avoid a U.S. shutdown, President Biden joins the UAW picket line in Michigan. Danny, good morning. The question is, have the bond vigilantes been reawakened to the extent they can do more serious damage to the equity rally that you've had for 2023? If you're going into the back quarter and you've already achieved a delivery on your portfolio, should you take risk off the table? There's a deleveraging going on. Stocks are lower across the board from the Americas through to Europe. Goldman Sachs Prime Brokerage tell us that hedge funds are cutting their leverage at the fastest pace since the 2020 crash. It was the unseating. It was the almost skirmish. It's a vertical move in bonds. It's not vigilanteism. So you are seeing this spike higher to 16-year highs in the bond market. You'll talk more about that. That is unseating the overall risk narrative. Morgan Stanley's clients are shorting tech and AI. And Europe comes lower. Bottom of your screen, by the way, is the miners. They are down 0.25% this morning. The basic resources component are still worried about China. Iron ore is down. China is under pressure. That is the malevolent backbone to the European story. Basic resources are down 14% year to date. Europe is on the back foot this morning as Morgan Stanley cut the luxury sector. The profits there, Danny, slashed by between 2 to 5%. So we'll keep an eye on the US translation to the likes of Tiffany, etc., here on the street this morning. Danny.
And Manus, the moves are creating superlatives across the board, and it's telling that finally oil has started to crack. The cuts coming from Saudi and Russia had been the dominating story. Yesterday at this time, oil was still moving higher despite the risk off. It's unable to do so now. Brent crude down 1%, and a lot of that has to do with the stronger dollar. Here's one of the superlatives at the highest of the year, highest level for the Bloomberg Dollar Index in 10 years. Westpac, Manus, you pointed this out to me, Westpac saying that the other international currencies are unable to fight the exceptionalism of the U.S. dollar. No one wants to fight that macro theme. We are having some of the bond bulls willing to peek their head out today, not by a lot. We're lower by about 1.5 basis points on the 10-year. We're still at, let's call it 4.5%. We're at the highest in 16 years. That's for the 10-year. The 30-year, Manus, that's at its highest in 11 years. Let's flip it up. Let me show you what the 530 is doing, because we are seeing this disinversion, this very rare bear steepening. 530s, that's back above zero for the first time since August. 210s, Manis, that is the thinnest since May. Again, this is rare. It's usually something that happens in a more benign economic outlook. Is it benign now? We're worried about the consumer. A lot of questions, Manis, about what exactly is driving the bear steepening.
Well, in part, it's got to be something to do with the inflation narrative. There is that higher for longer. But if you look at what Jamie Dimon said overnight, which sort of is a tailwind to everything else, we are ready for 5%. We're living with 5%, 5.25%, 5.5%. Nobody has got the lexicon of 7%. Nobody's got that in their psyche. Bonds, global bonds, by the way, Danny, the worst month of 2023. We've lost nearly 3% on the global bond market. And if Jamie Dimon is in any way correct and the trajectory of rates goes to 7%, you can kiss your sweet goodbye to a soft landing. Let's take that thought to our guest this morning. It's Anastasia Amoroso, Chief Investment Strategist at iCapital. So Jamie Dimon, puts the cat amongst the pigeons in terms of flying kites about 7% rates. In other words, we'll see who's naked, to quote Warren Buffett, who's wearing no shorts when the tide goes out. There you go. If they're going to have to lower volumes and higher rates, there will be stress in the system, and I'm not sure the world is prepared for 7%. What would it take to invoke the wrath of 6.5 to 7% rates? Could they? Would they? Anastasia, good morning.
Good morning. Well, first of all, 7% is, that's still not anybody's baseline scenario. But I think it is right to be talking about, with rates at 5.5%, potentially going higher, who are the vulnerable parties across the table? And so it is the right time to be doing some of those calculations. And we're very carefully digging into the health of the consumer, the health of the corporate balance sheets, the health of the commercial real estate. And when we do that assessment, Manis, what I'll tell you, at least looking at the U.S. consumer, only about 11% of the consumer liabilities in the United States are floating rate. So the rest of them are fixed. So even if rates were to go to 7%, it's not an immediate reset across the board for the consumer. The other thing I will say for the U.S. corporates, for example, looking at the S&P 500, only 8% of the debt is floating rate. So once again, it's not a wholesale reset that would leave everybody vulnerable. Now, clearly, commercial real estate is something to worry about, and there's $1 trillion or $1.5 trillion, depending on what time span you look at, of upcoming maturities, and there's certainly going to be difficulties there. But is it the same size of the loans that we had during the great financial crisis and residential mortgages? The answer is no. So I agree there will be pockets of distress, but I don't think it's a wholesale impact to the broader economy.
So if it's not a wholesale impact, there is still resiliency out there, be it for corporate balance sheets or the consumer. Does it make sense to you then to see the long end selling off? Is this a trend you'd want to chase after?
Look, it does make a lot of sense. And I know you were talking about what's the reason for this bear steepening. And I think there's several reasons why the long end rates are backing up. First of all is we have high for longer rates of 5.5%. So we had to reprice for that. And this feeling, had to sink in. And I think that's part of that. The second part is inflation expectations maybe crept up a little bit, and that impacted the long end as well. But there's also a good component to the backup in yields as well. And that is the fact that growth expectations are pointing higher. So if you're in the soft landing camp, you should be in the curve re-steepening camp as well. So it makes a lot of sense to me. And then, of course, it's the upcoming increase in Treasury issuance for next year as well. So, I'm not necessarily pounding the table and saying buy long duration here, but I do think, given how much the yields have backed up, I think we are due for a pause on long end.
And I like the way you frame it there, which is, to you, is logical. To a lot of people that were scratching their heads yesterday in terms of this curve steepener, was it about inflation or was it about supply or was it about growth? You say that 4.5% on Treasury yields is a return to normal. And with that in mind, and again, this goes back to decades ago. It's 16 years ago when we last had rates at this level. So the question is, do you buy the belly of the curve here? Danny was talking about the steepener there that you saw, which is back in the positive zone. If you want to take duration in this normal zone, as you call it, is it 5s or 10s, or where do you take it?
Yeah, I mean, I don't know if this is a great time to be taking duration risk, because, Manus, the reason I would want to buy, let's say, the long-end treasuries, if I believe the recession was coming, it was imminent, and I don't think we're there quite yet. So, and in the meantime, you have this, growth risk and also issuance risk. So if I were to buy anything along the curve, I would look to some of the shorter duration treasuries because you're not going to have the same mark-to-market volatility in those, even if rates do move a little bit higher. And I think we, at this point, should probably believe the Fed that they're close to done. So if it's another 25 basis points, I think the curve is appropriately priced for that. So I would stick with some of the shorter term maturities for that.
Yeah. Just on supply, this week alone, 134 billion of treasury auctions, about 20 billion of corporate bond sales this week. Sure, growth looks good, but you have supply, you have higher oil, you have strikes, you have all these things that are out of the Fed's hands. Do you worry about shocks? I mean, almost 5 different possible shocks that could hit this economy.
You're right. You have 5 mini shocks, I would call it, to the economy that are sort of all piling on top of one another. And there's 2 ways to look at it. First, it is negative for potential GDP growth in the fourth quarter, and that means a growth slowdown and maybe stocks don't do well. But if growth does slow down, but it doesn't turn negative, which is my base case, then maybe this move higher in yields actually pauses. And if that's the case, then that's a positive for stocks, and that could support the valuation of tech stocks. And I think, Danny, that's what happens because, third quarter was a bit of an anomaly. Everything worked in terms of growth momentum, but now you've got the auto worker strikes in the United States. You've got the potential, hopefully we'll avert that, a government shutdown. You've got the oil shock that's going to take some wind out of the consumption sales. So all of that means slower GDP, but I think the yield higher in rates pauses, and I want to be buying the spikes in rates, and I want to be buying the dips in tech for that.
You can hop off for a bit of lunch with Bob Michael, who wants to buy every dip in terms of these bond prices and the spikes in yields. Can I circle back to your thought process on the consumer? I get it. What proportion is floating, what proportion is fixed, and how injurious would an ever higher Fed be? But if I look at the savings rate, and this talks to, we put it into the GTV library, this is the savings rate in the United States of America, and it is the piggy bank getting smaller, and only 20% of, the richest 20% of Americans have excess savings. And that's ultimately about the end of COVID and the drying up of a great deal of the momentum in this economy. Should I be concerned about the piggy bank getting smaller?
Well, yes, in a way, because it does mean slower consumption in the quarters ahead, but that doesn't mean that the whole consumption story falls apart. I would say that excess savings was only one part of why consumer has been this strong, and we know that's starting to get tapped out. But what I also look to, Manus, is the fact that the unemployment rate in the United States is 3.8%. And as long as a person has a job and he or she is getting paid more for that job, I think that propensity to spend is still going to be there. But having said that, having fewer extra savings, that's a negative. Also, the fact that oil prices are up and gasoline prices are up close to 20% this year, that's also going to diminish, some consumption. So I would say slowing, but not derailing in the U.S. consumer story.
Okay, well, hold that thought. We've got a little bit more work to do, and we'll talk more about the oil markets. Anastasia Amoroso, our guest this morning, setting the tone for risk as President Biden heads to Michigan to join the UAW strikers. More on that story ahead. And we'll catch up with Rob Arnott, chairman of Research Affiliates, on, you got it, Danny's favorite, value versus growth, coming up later this hour, right here on Bloomberg Brief.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, we've finally seen some cracks in oil today. It's down about 1%, whether you're looking at WTI or Brent crude. Even so, it has been rallying. These cuts coming from both Russia and Saudi. The calls are growing for $100 a barrel oil. Anastasia Amorosa is still with us, Chief Investment Strategist at iCapital. Anastasia, I know one of your calls is to go long energy. We're in this world where JP Morgan, not just calling for $100 a barrel, but an oil super cycle. Is that coming? Is that what's in store?
I mean, look, there's a lot of good arguments for it. And one of those arguments is that it's very clear that OPEC and Saudi Arabia is very intent on bringing the level of global inventories down. And if they do that, that sets up this elevated oil price environment. And so as long as oil is somewhere between $70 and $90 a barrel, that's where you need to be in order to incentivize additional investment in oil. So, you know, I think the reason why some are calling for the super cycle is because we've been short on investments in oil and gas. And as a result, you know, there's quite a shortage there. So I'm in the camp that oil continues to stay around these levels because I think there's too many stakeholders that are trying to keep it in that range.
Yeah, I mean, Prince Abdulaziz bin Salman himself said, look, we're trying not to go back to the 1980s, but they're going to be darned happy in the 90s. Translate that macro oil move into the equity market for me, because traditionally what we've seen is sort of super buybacks and jumbo dividends, haven't we, within the oil sector? How much do dividends and buybacks matter, if in that sector, or for you going forward for next year?
Yeah, I think that's one of the other attractive reasons to be in oil and gas. If you think about it, by the way, that's another argument for the super cycle. If you think about what oil and gas companies are prioritizing, they're prioritizing returns to their shareholders in terms of dividends, in terms of buybacks. And if you look at either the cash flow yield or sort of the all-in, you know, cash return to shareholders, it's quite elevated for energy stocks. So that's one reason to like energy. But again, the other is as long as oil prices are 90 or maybe $100 a barrel and the break-evens are 50, let's say they creep up back up to 70, you know, that still gives those oil and gas companies a lot of cushion to have the profitability, to have the earnings growth, and also to return some of that cash. So, you know, I personally like staying long energy because, you know, look, we think inflation, you know, is headed back down to 2%, but in the event that it's not, in an event that we have too high of demand and not enough supply of oil, I want to continue to have an inflation hedge. And so that's why I think part of the barbell of equity investment is energy.
And then the other side of that you were saying is tech.
Yes.
They're not duration risk there, though. If yields are marching higher or they stay around these levels, can I still really be buying tech?
Well, tactically speaking, I do think there's room for yields to pause, you know, given the economic slowdown that we're likely going to see in the fourth quarter. But, you know, looking through beyond that, you know, of course, higher rates is one piece of the story. They dent tech valuations. But let's think about the top line and let's think about the earnings growth. And what we know is tech is likely to deliver double the earnings growth of the S&P 500. And the other thing, you know, what we have to do in this environment of return back to normal of, you know, 5% rates, we have to reduce leverage and we have to look for companies companies that are not over-levered. And guess what? That's the tech stocks. If I look at the net debt to EBITDA for all the sectors of the S&P, it is lowest for information technology. So you don't have a whole lot of fundamental detractors from higher rates there.
Let's just close off with your thoughts on risk. I started the show talking about leverage. You know, the prime brokerage give us their notes every couple of weeks. Goldman's, hedge funds cutting their leverage at the fastest pace since the 2020 crash. There's a loss of sponsorship from the retail market. Morgan Stanley, actually, they're taking the other side of your trade. They're shorting AI and tech at the moment, so that there'll be some rich offers for you to pick off. But when you look at what happened last week, some people say it was a risk parity week, bonds, stocks, and equities, all on the downside. Do you think we're at the start of a new cyclical dip, or is it contained? Are we going to pull back from these highs in the yields? Do you think that run is done?
Yeah, I think the technicals deterioration is maybe in the last few innings, and we've been seeing it for the last month and a half or so. I mean, if I kind of rewind back to the beginning of August, you had systematic traders that were very long equities. You had hedge funds that were sort of in the 80th, 90th percentile of net longs over the last year or so. So you had a lot of people into the long trade, but now the exact is happening in reverse, and you've got systematic traders that have reduced their positions. As you mentioned, hedge funds have put on the shorts, but guess what? As a result, you know, that's up a contrarian bullish setup. And by the way, both the S&P and the NASDAQ are sort of approaching these oversold levels. So I think we may still see some technicals deterioration over the next week or so, because the biggest buyer in the market is not in the market right now, and that is the corporate buyback. So the window is going to be shut by the end of the week as we get into the earnings season. But once we come back from that, you know, gradually throughout October, I think the technical will improve.
Right. Anastasia, thanks so much for joining us. I'm afraid that's all we have time for. Thanks for stopping by on your Europe tour. That's iCapital's Anastasia Amoroso. All right, quick check on markets as we head to break. Some of that technical breakdown still happening. Down 0.5% on S&P 500 futures. Dollar year-to-date highs. 10-year getting a bid, but still at 4.5% as crude drops by about 1%. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He
story.
is there to kind of upside.
boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, Manus, Republican and Democrat negotiators in the Senate are said to be nearing a deal on a short-term spending measure that would keep the government open until October 1st. Now, that legislation would extend funding for 4 to 6 weeks. It is a shorter time frame, though, than Democrats wanted. A U.S. shutdown would be negative for its credit rating. Moody's warned the only major grader to still have a top rating for the U.S. country, Manus.
Well, at the same time, we've got President Biden moving to join the UAW picket line in Michigan. That's today. Bloomberg's Oliver Crook joins us now. Oliver, good to have you with us this morning. I mean, we touched on this yesterday. We've preparedness to do this. This is history in the making in terms of a president going to the picket lines. Who does this help more? Do you think it emboldens the negotiation for the union, which the White House says that they're not talking about this deal? Or is it Biden's re-election campaign?
I think it has the potential to help both and potentially even hurt both, if you follow me long enough here. But this is, again, as you say, 100 years, there's not precedent for this, of a sitting president to go down and join the picket line. And it comes also critically at a time when public opinion of unions is the highest it's been since 1965. That's according to a recent Gallup poll. So there's the sympathy there. The UAW backed Biden in 2020. They have withheld their endorsement so far. Sean Fain has said Biden really needs to earn this. And the risk for Biden and for the union is that if this drags for a very long period of time, starts to inflict economic damage, it might test the sympathies of voters. And of course, Trump is going to be there on Wednesday trying to speak his own agenda, him really pointing to the fact that the EV policy by Biden is really the thing that's killing the auto industry in the U.S. That's the line he's going to push. And really, we have to emphasize how important Michigan, Wisconsin, Pennsylvania are to the re-election. They went Republican in 2016 when Trump won. They went Democrat in 2020. These are absolutely crucial states for this election.
Yes, the Rust Belt swing states. You mentioned the economic damage, Oliver. Obviously, a lot of that has to do with how long these strikes go on for. What is the current thinking there?
So let's look at one dimension of this, because I know that Manus enjoys crook accounting, not quite CPA level. But if you look at one dimension of this, the strike fund, which is $825 million, $500 a week per worker for every week they're on strike, 18,300 workers, that's about $9 million a week. That could take you about 90 weeks at this level, right? That changes, obviously, if they expand the strike and they decide to go all out. But the question is also, will this escalate? There are some signs of that as well. Ford saying that it's going to pause construction on a battery factory in Michigan that would employ 2,500 people. They say it's down to scrutiny over its ties to China because it's a joint partnership with CATL. However, the union taking a rather different view of that. In a tweet overnight, Sean Fain saying, this is a shameful, barely veiled threat by Ford to cut jobs.
Okay, Oliver, as you say, they've got to expand these strikes into the truck division to really have a grinding impact. Well done on getting the tweet in there, right on the edge. Oliver Crook in Berlin on the UAW. Up next, Rob Arnott of Research Affiliates joins Danny and myself with the favorite topic, value versus growth. What's good on Bloomberg?
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
as they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Traders recalibrate the path ahead. The bond sell-off pauses as yields hit multi-year highs. Even higher for longer. Jamie Dimon says the world isn't ready for 7% rates. Neil Kashkari says the Fed needs to hike again. And as negotiators near a deal to avoid a U.S. shutdown, President Biden joins the UAW picket line in Michigan. Risk is cracking this morning. It's very apparent through oil, which has stayed very heavy. It stayed bid through most of yesterday's sell-off. But today, that is not the case. We're down by about 1% on Brent crude. We're back below $93 a barrel. Part of that story, higher dollar strength, dominating everything. Westpac says that few currencies will resist the resiliency of the U.S. macro theme. Certainly what we're seeing, dollar at a year high. That's, of course, not the only superlative. We have a U.S. 10-year yield. That is at 4.5%. It's getting a little bit of a bid, but the bond bulls, for the most part, are disappearing, down 1 basis point. And Manus, 16 years ago, do you know what was top of the charts? Do you remember?
I know that we actually Googled this, and I actually can't remember what we Googled.
I'll tell everyone, I remember, it's Big Girls Don't Cry by Fergie. Manus, how could you forget that? September 2007, that's what was top of the charts.
September 2007, I think I was sort of caught up in a vortex of sort of post-Lehman crisis at Cantor Fitzgerald, ending my career in equities and going, why am I here? Look, I can't top your superlatives. What I can tell you is this, is that risk got spooked by the spike in yields yesterday. The question is it bond vigilantism round two, or are we pausing for thought? Equities are lower. Leverage is being taken out of the system, both in the US and across in Europe. You've got S&P 500 down 0.5%. Leverage is being slashed at the fastest pace since 2020. That's what Goldman Sachs prime brokerage are telling us. Morgan Stanley's clients are shorting tech and AI. Yet our guest from ICAP, Anastasia Amoroso, just said she wants to be a buyer of these dips in tech. She likes tech because of all of the hallmarks of the balance sheets and the debt structures. Europe is down again this morning, down 0.6%. Bottom of your screen, you've got the basic resources narrative. 24 hours ago, I talked to you about China and Evergrande and a liquidation risk. That is still very alive and very real. Is it contained within China? Either way, iron ore is on the floor. High beta currencies are down. Basic resources are down. Morgan Stanley are cutting luxury stocks profits targets by between 2 and 5%. So we have these renewed levels of pressure, but it's not vigilantism. Danny, good morning.
Good morning, Manus. And amid all of that, We've seen 5s, 30s. It's this disinversion that's taken hold. 5s, 30s, it's positive again. 2s, 10s, that's the narrowest since May. But it's notable, today it's bull steepening, but for the majority of that, it has been bear steepening. It is something that is very rare. Anastasia Amorosa said that it makes sense to her because not only are we reappraising rates, growth continues to be strong.
Yeah, but in her view, she quite likes the growth narrative. She says that's the reason why we get this pop in rates. She wants to be longer of the shorter end of the curve relative to duration at perhaps 7 and 10s. But adding fuel to this fire is, of course, Minneapolis Fed President Neil Kashkari. Danny, he says that the Fed will need to raise rates one more time this year if the U.S. economy is stronger than expected.
There's a lot of uncertainty about where we are in terms of how tight is monetary policy right now. And so that's why, if you look at the SEP, the forecast, or the projection rather, we have a majority of participants have us raising rates one more time this year. I'm one of those folks who has that. But basically, we're going to take our time, see what happens to inflation before determining how high we need to go.
Kashkari talking about another hike. Diamond talking about not being able to handle 7%. Bond yields march higher. Amid all of that, let's bring in our next guest. It's Rob Arnott, chairman and founder of Research Affiliates. Rob, really great to have you in London. Great to have you in the set. How would you describe this current period that we are in? Are we in a readjustment to higher rates in this market and in a different environment for risk?
Of course we are. We are in an environment where we're coming off of a decade of zero rates. Think of interest rates as a speed bump. If there's no speed bump, you get reckless driving. And when it comes to the macroeconomy, you wind up with malinvestment, misallocation of resources, propping up of zombie companies. You wind up with corporate welfare. You wind up with a whole array of ills that take time to heal. When rates get too high, you have a speed bump that stops innovation. And so what we lack is a central bank that's willing to have a steady hand at the tiller, that paints itself into corners one right after the other. Yield curve inversion is known as one of the best predictors of recession. I would argue yield curve inversion doesn't predict recession, it causes recession by inhibiting innovation, inhibiting investment in new ideas. So what we have right now is an inflation-fueled rise in interest rates, which acts against the macroeconomy.
So, Rob, with that in mind, you talk about, good morning from New York.
Hi.
So the Fed, in your view, has boxed themselves in. Therefore, do I need to countenance what Jamie Dimon has suggested? If they need to take volume out of the system, they may well need to go higher. Is that something that the market just has not been able to even get its head around? It can't get beyond 575.
Well, yeah, the market can't get its head around rates that go to levels that make no sense. The Fed claims to be data dependent. The data that they pay no attention to is the long bond yield, which is set by supply and demand. It's set by the macroeconomy and by the competing views of millions of investors. If you view that as your anchor, why not simply say, under normal conditions, we should keep the short rate a little below the long rate, 0.5% or 1% below the long rate. Australia did that for about 25 years, and Australia has been called the lucky country because it went 30 years without a recession. I think there's no coincidence there. I think recessions are unnecessary, and I know that's a provocative thing to say, and I think central banks often are the proximate cause of recessions when they occur.
That is interesting, this idea that, again, it limits innovation. But I could counter to you and say, Rob, look at this world awash in AI, something I know you follow very closely. There's advancements. They're still spending. Corporate balance sheets are still healthy. What to you says that this curve is creating a recession? Where do you see that happening on the ground?
Well, one of the things about central bank policy is it acts with such a lag. So if the notion is let's raise until there's evident slowing, okay, you've baked in several quarters of slowing by the time you notice the first evidence of it. And so that's one of the key issues. We have a central bank that remember back, well, you won't remember, but back in the Vietnam War, there was a famous colonel who was quoted saying we had to destroy the village in order to save it. Now, if you're a central banker, you have one tool. You can crush demand. Inflation is caused by supply and demand mismatch. If you have supply chain disruptions, if you have people working from home or being paid not to work from home, being paid to simply stay home, if you have people pretending to work from home, all of these things reduce supply of goods and services. If you have airdrops of money into people's accounts, that increases demand. And as a consequence of the supply-demand mismatch, you have inflation. Unless there's a willingness to recognize that policy choices caused inflation, then there's not likely to be policy choices to reverse those causes of inflation.
You talk about the supply and demand argument there, Rob, and undoubtedly the supply side was the COVID angst. Here we are, the helicopter money is done. We've just spent time with ICAP talking about the cracks in the consumer. The savings rate is dropping. The amount of disposable income that Americans have, and indeed around the world, is dropping. Morgan Stanley warned that this fissure can turn into a gusher. Would you agree with that? And how do you position for that if you agree with the thesis?
Well, I do agree with the thesis. I think that we're laying a foundation for relatively high odds of recession, increasing odds of a hard landing, and an unnecessary hard landing. I would love to see a central bank simply take a very patient, steady hand at the tiller approach and anchor on the long rate minus a little. That's not been done. The long rate minus a little would mean you never got to zero. You went from 0 to 2% in one single move. That would have been a step in the right direction. But taking it up from current levels, I think, builds on the risk of a hard landing.
Okay. Now, you also mentioned that rates don't make sense where they are. What would make sense, Rob?
Well, as I said, long rates minus a little.
Yeah.
So if the long rates are 4.5, if there's long rates are 4.5, why not take the Fed funds rate to 4?
So you think they should be cutting at this point potentially?
I think they should be cutting. Now, all of this has a lot to do with markets and a lot to do with the value growth cycle. One of the things that's happened this year is tumbling inflation expectations on the back of rolling 12-month inflation that keeps getting better and better through June. Well, why was that? First half of last year, we had 6% inflation in the U.S. Second half of last year, we had 0.5%. So that means the first half of the year, this year, we were replacing 1% a month on average. Second half, we're replacing 0.1% a month. So back in January, we predicted that inflation would hit about 3% at mid-year. In fact, our forecast was 2.9, and would snap back to 5.7 by the end of the year. I still think 4.5 to 5.5 is a likely year-end range. That's going to shock people. It shouldn't shock people because all we're doing and dealing with is a base effect.
Right. Hey, Rob, stay put. We have much more to cover. Going to quickly go to a commercial break. That's Rob Arnott, who's sticking with us. This is Bloomberg.
Next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
For
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
This is Bloomberg Brief. I'm Menace Granny in New York. Danny Berger at London HQ. Rob Arnott is our guest this morning. Research affiliates talking inflation, talking growth versus value. Rob, you left us with a tantalizing thought, which was we will be in shock, or the markets will be in shock because inflation will be a lot higher than perhaps they anticipate, 4.5% to 5%. Roll that into growth to value, because logic to me is if inflation is in the upper fours, then I don't want to be long growth, do I?
That's exactly right. What we find is that there's a relationship between interest rates and the growth value cycle. It's not a strong relationship. There's a relationship between inflation and the growth value cycle. That one is strong. So when you have inflation expectations tumbling, as we did in the first half of the year, based on an illusion of falling rates, because the comparisons the year earlier were 1% a month, that illusion of tumbling inflation helped to fuel the surge in growth relative to value. Now we're experiencing the reverse of that. Plus, people are starting to ask, okay, is the AI miracle all as miraculous as is commonly perceived? Markets are driven by narratives, and that narrative is starting to get some questions.
That's the thing, though. It's starting to get questions, but are we there yet? I look at ARM, for example, traded below its IPO price, but now it's back above it, $54. I'm going to be honest, Manis and I were talking, and we said to one another, all right, we have to ask Rob, it's below its IPO price. Are we finally there? It's not anymore. It gained again yesterday. I mean, have we finally come to terms about what this means for big tech?
I pay very little attention to day-to-day and week-to-week movements.
Keeps you sane, I'm sure.
Yeah. On a long horizon basis, there's a concept called big market delusion, which was pioneered by Brad Cornell, former professor at Caltech. Big market delusion basically says if there's a brand new concept that people know is going to be big, could be the internet, it could be electric vehicles, it could be AI, the narrative will tend to get ahead of itself. And the narrative embraces the notion that the powerful players in that big market will remain the powerful players 10 years hence. That it ignores the fact that they're competing against one another. It ignores the fact that there are a few winners and a lot of losers in any new big market. It ignores the fact that new competitors come on the scene. And so with big market delusion, you get the creation of bubbles. This reminds me a lot of the internet bubble. The narrative was the internet will change everything. It'll change how we get our news, how we interact with friends and family, how we communicate in business. It'll change how we buy and sell goods and services. And don't worry about earnings because they're coming. That narrative was correct. Narratives are often correct. That narrative was wrong only in the sense that it didn't happen as fast.
Rob, with that in mind, I mean, essentially what you're channeling is the Alan Greenspan speech, which was made about the paradigm shift of the internet. And yes, it took a few years to get there. I'm drawn to the one word. I'm trashy, but I want to know where the biggest bubbles are. You know, where's the myth and legend? We've seen some repricing in equities. I put that down to profit taking. We've seen a little bit of a spike in bond yields. I wouldn't call it vigilanteism. So where is the propensity for bubble? Dollars at a year high. Where's the biggest bubble for you? Outside of AI, or is that the singular biggest risk to markets that it pops?
I think that represents a risk. I think crypto represents a smaller risk. There are, if you look at AI, the narrative is correct. This is going to change everything, but it's going to change everything gradually. And that's the gap that makes the difference. We wrote a paper recently, the AI NVIDIA Singularity, in which we posed the question, is this a breakthrough, a bubble, or both? And to cut to the chase, our view is that it's both.
Yeah. How then, though, if everyone's obsessed with that at this moment, Bank of America in years past have talked about it as the Pavlovian urge to buy big tech. How does value outperform? You say that they're growing, but they're not loved. What changes to make them loved?
The tailwinds for value in the coming couple of years and extending out over very likely the coming decade are very simple. Firstly, it is near record cheapness. It reached an all-time record cheapness by many measures: relative price to book, relative price to sales, relative price to cash flow. Record cheapness relative to growth in the summer of 2020. Now, the narrative that got it there was very plausible narrative that had large doses of truth. It bounced back to test those lows near the end of 2021. It bounced back to test those lows in the summer of 2023. You don't often get a triple bottom. You don't often get a third bite at the apple when something gets abnormally cheap. And then the question is, what would be the catalysts that can allow things to turn? One of them is inflation being stickier, longer lasting than expected. One of them could be higher interest rates, meaning a higher discount rate for the long-term growth of the growth stocks. One of them could be higher instability in the economy. There's no such thing as high but stable inflation. Instability works to the detriment of growth because you wind up having people seeking a margin of safety. They want the underlying earnings. They want the dividends. And in addition to that, you have the risk that the Fed engineers another recession, almost deliberately, and in so doing creates further headwinds and further catalyst for the bursting of a bubble.
Okay, Rob, I'm afraid we're going to have to leave it there. Really wonderful to have you on. Rob Arnott of Research Affiliates, thank you so much.
Thank you so much.
All right, coming up, we're going to take a look at some of the market-moving events to watch throughout the day. And here's a quick check on your markets. S&P down 0.5%. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our RNI, where there's this billion euro we spend every year. Most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. All right, let's get you set up for your trading day and what we are watching. President Biden is going to be heading to Michigan. He'll be joining the strike of UAE members on the picket line. Former President Trump is also scheduled to land on Wednesday to host an event with the auto workers. And we are also going to be getting new U.S. home sales. That'll hit at 10 a.m. Eastern. We're going to get some other data, too. That includes the Conference Board Consumer Confidence data. We are concerned, if you're Morgan Stanley or some Fed surveys, about the consumer. Plus, central bankers speaking this afternoon include ECB Governing Council member Robert Holtzman at 12:30 p.m. and the Fed Governor Michelle Bowman at 1:30 p.m. Manis.
Yeah, well, we just had that conversation with Rob Arnaud saying that the Fed has boxed themselves in terms of the ability to do more and that they perhaps shouldn't have got themselves to 5.5%. Some of the big movers this morning, equities are lower, but the prism of risk, I think, is through the FX. Danny, you mentioned it in the market touches, which is the dollar. The dollar's at a 9-month high, and Westpac encapsulated this. We're up for the 5th day in a row on the dollar. She's still holding on to just the green. Westpac say few currencies will resist the bullish US dollar macro resilience theme. It is the best haven if, guess what, Danny? If we shut down. So that is part of the muscular framework for the dollar. And look at the pound. The pound is down. That lunch at the Ivy is getting cheaper and cheaper every day. I just need the airfare to get there.
You still owe me that. I mean, I'm not fighting the U.S. exceptionalism. Manis, you know, I've become a British citizen today.
I think we should ring a bell.
I'm tied to that sterling trade. I'm tied to that sterling trade for the rest of my life. Right now, it's not looking so great.
Tell me this, do you like have a pledge of allegiance? I'm sort of getting ready for the American citizenship in 10 years' time. I've just about got a visa to get in here. What do? Pledge the allegiance to King Charles?
I have to, yes, I literally have to swear my fealty to the king. I don't know, do I have to take up arms? I think I'd look pretty good in a Beefeater hat. So, you know, if I get to do that, sure, why not?
You pump that out wherever you go. Look, we're talking about Biden going to Michigan, but we've got a line coming through on Tesla, and this is Tesla's Chinese exports are a target of EU anti-subsidy probe. Now, we've seen price cuts by Tesla literally every couple of months. So this is a new line on Tesla. There you go. This is the pre-market. We're down 1.4% at the moment. It's an interesting kind of punch from the EU, Danny.
Yeah, and we know they've already opened an investigation to different Chinese car manufacturers. So according to people familiar, the aim of this Manis is to what degree China subsidized Tesla and some of those domestic manufacturers like BYD and NIO, and to take any necessary countervailing measures to level that playing field. That is the aim of this probe.
Well, let's see where that goes. I think the other couple of things just to keep an eye on, miners are lower. There's still China angst over Evergrande. So you have a debt woe there. Kit Dukes' notice just come through from SocGen. I think he's been listening in, Danny. He's talking about the bond vigilantes being in charge. That's what happens when you tune into Bloomberg Brief at 5 a.m. in New York. We frame the narrative.
I was going to say, everybody should be tuning in to get a nice narrative. All right, well, that's it for Bloomberg Brief. Surveillance is ahead. Manis, good morning from London.
Good morning. British citizen number 1, Danny Berger.
that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
U.S. growth both accelerating and surprising to the upside. That's something that's going to change.
The U.S. economy near term will probably be slowing down.
When I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not.
What people have been doing all year, which has confused me, is sold bonds but said that they liked them.
Right now, we're still in the annoyance phase of inflation. That's why we think it'll persist.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It's FX Tuesday. We're looking at markets that speak volumes. Futures at negative 25, more substantially lower than where we were 24 hours ago. Dow futures at negative 160. The VIX was an 18 level, 17.66, but away from the markets. Lisa, foreign exchange is a litmus paper for the system this morning.
The dollar very much front and center. It has been, although giving back a little bit of it. The irony here, as we talk about dysfunction in Washington, D.C. and the haven of choice, is the dollar, the currency of the nation, which raises a question, are we hitting a breaking point? And that's something you've been asking quite a bit.
Well, it's a theme that we're going to go through today. Lisa, of course, has got an edge of gloom over what I'm doing here. But, boy, does each pair in the triangulation of foreign exchange speak to what we see in the bond market. We'll do it in the data check today.
You buried the lead. We came in and having like a real argument about how much gloom was warranted. You said this is something that always happens in this time of year, and it feels different to me. I do think that the yield space feels different because there is this backdrop of what does it mean if you have rates that can keep climbing, potentially, if you listen to Jamie Dimon at 7%, in the face of strength, does that lead to weakness in stocks?
We're going to get the Dimon comments, and he looks out at the least, I guess the least likely outcome, but it's a gloomy outcome of much higher interest rates. We're also going to have John Farrow on assignment. Let us announce it in the 7 o'clock hour. Mr. Farrow, in conversation with the former Prime Minister of the United Kingdom, Gordon Brown, Michael Spence, the laureate of NYU, and of course all his work at Stanford, and Mohammed El-Arian. This book is anticipated Permacrisis. Bramwell came up with a title, and there it is, Permacrisis, and it's about, okay, how do we extract ourselves from these post-COVID challenges?
Especially at a time where we are readjusting to new rates. And that's really the underlying question. Can we get to a new rate regime of higher rates without something breaking? And people keep asking that question. The answer was yes, yes, yes. And now people are saying, well, if it keeps climbing from here, are we still so confident that nothing will break?
We're leaning on foreign exchange today, but let's go to the bond market and talk quickly about this, Lisa. What I want to know from you is if I see a real yield out to 2.17%, 5-year real yields is up, is well, if I see 2/10 disinverting, if I see that 450 now 451 on the 10-year yield, what are spreads telling? Are they finally a corporate and high yield spreads giving away?
A little bit, particularly on the riskier sphere. You are seeing a bit of spread widening. In other words, the premium is increasing that investors are charging over benchmark rates. But the key question here again is when do risk assets fully adapt to this idea of higher yields? Bank of America strategists put out this morning. Do rates really matter for stocks? And I would say for all of risk. If so, it's not priced. And this has basically been the theory at a time when yesterday the 7 magnificent tech stocks did just fine, even in the face of the highest yields going back more than a decade.
We'll get to Tesla news here as Tesla was down a little bit here off some news. We'll talk about that in a moment. Let me do the data check. And today we lean on foreign exchange. It's what Bloomberg does best. Futures at -23, the VIX 17.59. In the yield space at 450 level, Lisa was talking about 451, and we were higher much earlier, 511, 512 make it on the 2-year yield. Oil doesn't give me much, 92 on Brent. And in foreign exchange, we could go on for the hour. We won't. Yen, a 149 level. DXY, that blended major trading partners breaks through. Simon, give me that chart if you would. This is the Bloomberg Dollar Index, folks. And this goes back to the financial crisis, back to 2007. And this has been the great missed call on the street. Everybody looking for weaker dollar, and the all-in what's called BBDXY, Bloomberg DXY Index, up 5.7% since mid-July, and they're back. That's something. Brief us, Lisa, brief us.
Here's the data that for today. It includes a lot of information about the housing market, which a lot of people would say is broken. We get some U.S. house price index data throughout the morning. And this is really what I'm watching. And this is going to come out at 9:45 a.m. The S&P Case-Shiller year over
for
year.
Radio, that's an off-the-cliff
kind of pricing that we have here, which you're seeing declines that we have not seen going back to 2012. We also get consumer confidence data, as well as the U.S. Treasury auctioning off 2-year notes, about $48 billion of those at 1 p.m. 12 noon, President Biden joining the picket line in Michigan with UAW workers. Politically fraught, but this is viewed as a win for him because he has actually gotten the support of them a day before the former President Trump heads to the same area and tries to recruit the same votes. And then at 1:30 p.m. Eastern, Fed Governor Michelle Bowman is planning to speak. And this comes after yesterday we heard from Neil Kashkari. He still expects one more hike by the end of the year. Again, there is this bias for, yes, higher for longer, but maybe that the risk is still to the upside in terms of how high rates have to go.
We'll have to see. We're going to talk about that. Ben Layler with a smart note out this morning. Right now, we get to our guest and very experienced. Russell Kosterich is Global Allocation Fund Portfolio Manager at BlackRock. What are you doing now? The bears are out in force. We're not down all that much in the equity market, but bonds move. What are you doing, Russ?
Good morning, Tom. You know, right now, the truth is we're kind of holding steady. I think that we're seeing right now there are a couple things going on. The first of which is you have seasonal weakness. We have it every year this time of year. So far, it's about what you'd expect, but as Lisa mentioned, there are some other issues. 2 things that I think you've got to be aware of. The first of which is we're back in an environment like 22, at least temporarily, where you're punished for high volatility, low quality assets. The market is rewarding consistency. And if you're an early growth stock, you're an EM stock, you're a small cap stock, you're getting penalized. So focus on going up in quality. And the other thing is, you know, clearly we're in an environment, as we've been for much of the last 2 years, where bonds have not worked as a hedge. What has worked is the dollar. In an environment where people are scared of the Fed, they're scared of what central banks are going to do.
Did I lose Russ?
The dollar works.
Russ? Why don't you pick it up? Why don't you pick it up?
Russ, there's a real question here as you talk about being more cautious, what that means in an era where bonds are not the cautious bet.
I think it means that you have to think about where else in your portfolio you're going to get that hedge. You know, again, for 20 years, bonds were remarkably good. They gave you this incredible risk-adjusted return on a portfolio, and we haven't been in that environment now for coming on 2 years. So what do you do instead? I think you do a couple things. In this environment, as I was mentioning a moment ago, where the Fed is probably the shark closest to the boat, the factor that's most disrupting markets, the dollar can actually be a very effective hedge because it's negatively correlated with stocks. The other thing to think about, watch the volatility in your portfolio and look for quality. Look for companies that are generating consistent revenue, generating consistent margins. You mentioned before, the Magnificent Seven did well yesterday, despite the fact that rates were surging. Part of the reason for that is most of the names in that little group, they generate tremendous cash flow. They're not the ones that are most at risk. The ones that are most at risk are the early growth names that their cash flow is 10 years in the future.
Interesting. Lisa, I'm sorry, I lost my audio there to Russ. Did I miss it? Did he mention the triple leveraged all cash fund?
Well, he's talking about the triple leveraged dollar fund. And I want to pick up on that, Russ, this idea that the dollar is really the best hedge against equity volatility. Are you basically saying that it will ignore and possibly even be an even better bet, regardless of some of the circus going on in Washington, D.C.?
Well, I think that in the time frame we're talking about, yes. Now, just be clear, I don't think you stay long the dollar till the end of time. One of the things about this environment is your hedges are changing. Back in March and April, bonds worked because we were worried about another banking crisis. Since the summer, the dollars worked. So it calls for a more dynamic portfolio. But again, I'd say two things. Right now, in an environment where the Fed is what investors are most concerned about, the dollar's effective, and I would guess that the market is going to look past some of the shenanigans in Washington and focus more on what the Fed is doing than what's happening in Capitol Hill. If we're worried about rates grinding higher, that dollar's still likely to be negatively correlated with stocks.
Russ, what's your sense of this Jamie Dimon call for 7% rates eventually, that that's a possibility? Do you also see that as a possibility, that the risk right now is to the upside in terms of benchmark rates, and that eventually will cause an end to the rally that we've seen even in the Magnificent Seven, which you do like?
Well, sure. Look, I think we had a 7% on the policy rate or even 7% on the 10-year. That's going to disrupt markets. We have a very levered economy, and I have a lot of respect for Jamie Dimon. That's not obvious to me because I think a couple things are happening. The economy is slowing. Inflation is decelerating, albeit at a very uneven pace. And I think there's some recognition by the Fed that if you tighten financial conditions much more, you're going to do real damage to the economy. And let's remember, since the Fed's last hike, real rates in the long end have gone up quite a bit. The dollar's gone up, and we're seeing more contraction in credit and lending. So I don't see us going to 7%.
Ben Laidler with a blistering short note this morning, Russ, and I thought of you actually. And he's talking about the Fed put coming back. And not played into this is how the Fed responds a la Greenspan 15, 20 years ago. And I think what you're suggesting here is the Fed has a lot more power to change the dialogue if they get the data and if they choose.
I think that's right, Tom. And I would also say that I think between the renewed bond vigilantes that we thought were gone and clearly have come back, and the dollar, and we're seeing in lending markets, some of that tightening that the Fed was concerned about to slow the economy has already happened outside of the Fed's actions.
I look at the correlations today, and clearly it's going to be a foreign exchange Tuesday, folks. There's no question about that. Which major pair is your closest study this morning?
I think that the pairs that generally we're thinking about have been the ones that are represented in the DXY. So, they're the large pairs, whether you're talking about the euro and the yen, and there are others as well. But again, what we're thinking about here are the rate differentials. And if we continue to see an environment where, justified or not, the concern is the Fed's going to keep going, that's going to favor the dollar on a lot of these developed market crosses.
Russ Coster, thank you so much with BlackRock this morning to get us started. Here, Lisa, which pair are you looking at? I mean, I know it's a game here, but today, it really is, folks, Foreign Exchange Tuesday. I mean, that's where we are. What are you looking at?
Well, I have been looking at the euro, this question around how far and how deep it can weaken versus the dollar. But in general, I just think it's fascinating that the dollar is sort of the haven call, regardless of the fact that the U.S. is the epicenter of a lot of the political drama. And so at what point does this sort of create a difficult moment for the rest of the world?
Well, you know, what you do, folks, like on euro yen that Mr. Kostras just mentions, is you take dollar yen or euro yen, and you have to triangulate which pair gives you the most information. Right now, I'd say it's dollar yen because you're buttressed right up where we've seen MOF and BOJ. It's an alphabet soup, EIEIO. But you see where they intervene in Japan.
Well, here's the issue. And when you take a step back, there's this feeling that suddenly we have to readjust to a higher for longer type of regime, this idea that maybe this isn't going to kill inflation. And if you have that kind of regime, everything is going to have to reset higher, including in Japan. So people are still going to be gaming out when they're going to have to abandon their negative yield policy.
Well, let's look at the calendar. End of September. Okay, it's end of September. We're going to get some data in. We do have the shutdown. Very important. Greg Villiers writing about that today. But the heart of the matter is they're starving for data. We get the jobs report, and then, you know, let's assume the shutdown gets fixed. An inflation report. We're going to know a lot more going into middle of October than we know right now. Maybe that will calm down where we are.
Honestly, the idea that we're not maybe going to get some of the data is going to be a real concern, right? I mean, how much does that affect the Fed? To me,
how much does it
like
affect us? Did you see the 30-year mortgage rate? 7, went right back up to its new high. I believe in this morning's print, the bank rate's going to give you a new high for a 30-year mortgage.
Do you think that we can call this housing market a market at this point? I mean, is it really a market, especially of existing homes, if you take a look at some of the sales?
I think it is the price of what we've seen in central bank action is what I think. It is an amazing Tuesday here to synthesize it. Emily Rowland in the 7 a.m. hour with John Hancock. Stay with us, Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I haven't talked to leadership. I've talked to all of Congress saying it is irresponsible and inexcusable that you would let government shut down.
And what's the response?
It is also irresponsible and inexcusable to not cut all of the spending. They are using our budget and keeping it in pandemic spending. We're no longer in a pandemic. Why are they still spending at those levels?
A Republican candidate with some visibility. Help me, Lisa, here. It's tomorrow night, right?
Yes,
Nikki
it's tomorrow
Haley
night
speaking
in California.
with Alex Steele, American Energy Security Summit, Oklahoma City here. We're going to get shutdown updates through the morning here. But as we look at the markets, we're going to also dive into some very careful analysis of the budget. We'll do that in a moment. If you're joining our equities with some weight to the tape here and down 22 on the S&P 500, that is more than yesterday. Were you surprised, Lisa, by the little uptick? I mean, we got some green on the screen yesterday. I'm like, really?
Yeah, driven by the big tech. It was really surprising. And again, it goes to this question, do they care about rates being higher?
Yeah.
Rates were hitting, multi-generational highs, and yet stocks kept grinding it out, especially the tech stocks. Remember when we used to think they were interest rate sensitive?
Well, yeah, but I'm going to go back to, fiscal 101. The real rate is 2.15% this morning. It was 2.17. And just as one talking point, given UAW, I saw auto delinquencies on loans. They've moved. I mean, there's a tangible bad news there.
Do you want to hear my fear? My actual fear right now is that people are basically so sick of talking about recession that they've taken the bad outcomes off the table. And everyone has basically bought into this idea that the economy is resilient and can keep going ahead, even as people start to feel the strains of higher rates in a more material way, because there are long and variable lags. And that it will become as a surprise after a year of people getting the recession call wrong.
Bramonomics there, and of course that pushes up against soft landing, which was last week's story. And right now, we don't see that. And foreign exchange market at 106 on DXY is of note. Yen out near a 149 level globally of a great note. Cable, John Farrell mentioning this too. I mean, look for his interview, Permacrisis, in the next hour with Brown, Spence, and El Arian. Sterling 121.83, ever weaker here. You really wonder where that's going to end up. Right now, without question, our interview of the day on our debt, our deficit, the famous Heilbronner-Bernstein monograph of 30 years ago. Maya McGinnis doesn't remember that book. She's too young, but Maya McGinnis truly owns a high ground on debt. She's the president of the Committee for a Responsible Federal Budget, an equivalency there to what we see at the Congressional Budget Office, and we're thrilled for this brief this morning. Maya, yesterday in the mist, somebody said, let's bring back Simpson Bowles. We've done this before. We've had independent commissions, and then the politicians ignore those commissions. Is that where we're heading?
Well, I actually do hope that we're bringing back a commission, because one thing is certain, which is our partisan politics are not going to resolve this issue, let alone really confront the huge fiscal issues that are the things we should be talking about, right? Keep in mind the policies that we're about to shut down the government over, it looks like, are just a tiny fraction of the government. And what we have is a situation where our politicians, in the moment that we are facing record levels of debt, interest payments being as much as defense spending in the next few years, a whole long list of risks, our politicians are promising not to do the things that we actually have to do to fix the budget, whether it's raise taxes, reform Social Security and Medicare, or continue to cut spending. So I do think the idea of a fiscal commission could help insulate the lawmakers from the hard choices and the really difficult politics. But as you pointed out last time, Simpson Bowles didn't even get a vote.
Yeah.
So we need to build in a process where it is guaranteed to have a vote if they come up with something through an expedited process, again, to insulate it from the really poisonous politics on this issue.
Maya, the primer for all of us on this, including Pete Peterson and others, Paul Tsongas, that led the charge on a responsible debt, was Heilbronner and Bernstein's The Debt and the Deficit, this 34 years ago, folks. And what they basically said was, everybody calm down. You're conflating family accounting, which is what we all use, Maya, versus the accrual mysteries of the federal budget. Is this budget like what Heilbronner and Bernstein knew, or is this budget out of control?
Well, this budget isn't like a family budget for sure, because we have the ability to tax, but it also isn't a budget where any of the signs are saying, don't worry about things. For years, we actually had people saying, interest rates are so low, don't worry, we have the printing press, we can borrow all we want, we can print money. Now we saw that fiscal policy helped kick off the inflationary situation that we are in. And that even though interest rates were low for a long time, now that they've gone higher, and we have this much greater debt because we did borrow so much in the past decades, not just for COVID when it made sense to borrow, but when the economy was strong, when it was counterproductive. Now, with every small increase in interest rates, our interest payments grow dramatically. And so now we're in this dangerous situation that resulted from people saying, don't worry, there's not a problem. And I would also make the point that fiscal fiscal irresponsibility, where we have been, used to be really about an economic threat, slowing growth, leaving us unprepared for big emergencies. But now it's more than that. Now it has really expanded into a national security threat. And our fiscal vulnerabilities are also our geopolitical vulnerabilities. And we have to think about this on the broader stage in terms of the risks we have created.
Maya, is there any party or any member of any party having a responsible discussion about some of the aspects that need to get changed in the budget in order to get to a more responsible budget in your view?
There are a lot of members. There's a group in the House called the Bipartisan Fiscal Forum. There's the problem solvers. There's many members of both parties who are talking about the issues. But the problem is you can't go out on your own and say, listen, America, I'm going to tell you the truth. We have to fix Social Security. We have to fix Medicare. We're going to have to raise higher revenues. They can't do it alone, or the attack ads are written before they're done talking. So there needs to be a kind of a bipartisan space where people can talk about this. Again, that's why I also turned to the idea of a fiscal commission to create the safety of a bigger bloc saying it's time to level with the American people. I think it will be really interesting what happens in the presidential campaign. You just had a bit of Nikki Haley there talking about the issue. She's been bringing it up, but we have a situation where both former President Trump, President Biden are promising not to fix entitlements, for instance. That can play well with the public, but it's not the truth. We're headed towards insolvency in both of those programs, and we'll have across-the-board cuts if we don't do something to fix them. So it's really important that we have truth tellers during this campaign to create sort of a mandate for addressing this in an honest way and confronting the trade-offs.
We saw Ms. Haley talking with our Alex Steele there, and it was a very simplistic analysis of this process. And I would suggest many, both Republicans and Democrats, Maya, in Washington, bring this back to basically Home Ec 101. How are we going to do this outside of a commission? I mean, is the committee system that you were weaned on still, like, does the Appropriations Committee still appropriate like in our youth?
So the budget process is plain out broken. And it's not entirely surprising. We put in place budget rules. These were put in place in the 70s. And then Congress slowly figures out how to do end runs around them. They erode, they break, and you reach a point where they're no longer working. Our budget process needs a huge overhaul. Keep in mind, the Senate Budget Committee didn't even bother to put out a budget this year. They just skipped it. And both of those committees skipped it for the past few years. You shouldn't be able to go forward with work until you've put the budget out. So we're going to have to do a major overhaul and look at things like what kind of fiscal requirements are there? How do we insist that budgets are put out? I will say there's a big brewing problem on the horizon, which is we avoided default a few months ago, thank goodness. But we have to deal with that debt ceiling in 2025 again. And I don't think it's going to be a smooth sailing. So I think we have to reform the debt ceiling. We probably need to put in place something like auto CRs, automatic continuing resolutions, so we aren't talking about government shutdowns. But to your question, no, none of this works anymore. The budget rules are being ignored, broken, gimmicked, and we're going to have to do a big effort to fix the budget process and change it into something really different that starts to function again.
Thank you for the brief. Maya McGinnis with the Committee for a Responsible Federal Budget. I can't say enough, folks, of the importance of this. Our Washington team and Bloomberg News will continue to look at this, particularly from groups like that and from the Center, the Congressional Budget Office. Case-Shiller, housing data, you mentioned it in the brief. Negative statistics. Wow.
We're starting to see prices go down. And have they really readjusted to the idea of, what'd you say, 7.75% mortgage rate?
Yeah, that's the mortgage rate. Survey under 0 for Case-Shiller year over year. John Farrow in the next hour with Brown, Spence, Ellery, and David Page next.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Bloomberg Surveillance, Jonathan Farrow, Lisa Bramlett, and Tom King. Mr. Farrow on assignment. You'll see him in the next hour, about an hour and 15 minutes from now. Jonathan Farrow from Queen Victoria Street with the former Prime Minister Gordon Brown, the laureate Michael Spence, and also a guy named Alarian. These are three competent people in different areas, and they've got a book out, Permacrisis, a plan to fix a Bramwell world. It'll be interesting. It'll be interesting to see. Is your life a permacrisis?
100% yes, but that's just genetic. I will say, though, there is a concern that people have that we have gotten so sort of immune to this latest rate hike. Yeah. Because if you think about it, people are moving beyond the permacrisis. Everyone was looking for a crisis. Everyone was looking for a quick buck, and it never happened in the past couple of years. Even during the pandemic, it was like, that's technical CFA,
yes,
a dip, good. And then V-shaped recovery in the stock market, and people have kind of moved on. So what is this new world? Have we actually moved
to me,
past?
The new world, and you see in the UAW strike, is we're coming out of the pandemic. What definition of that was? I was in the Weill Cornell yesterday just doing the routine checkups. Guess what? They're all back to masks. I was real shocked to go in and say, hey, for us, COVID's still here. I was not expecting that.
Yeah, it is still here. We have people in our orbit that have COVID.
They do.
And
so does everybody
differently.
else.
Yeah, it's been treated differently. Here's what we're watching this morning. Under surveillance, Minneapolis Fed President Neel Kashkari saying he expects the U.S. will need to raise interest rates one more time this year. This builds on what we heard from others. He was at an event in Wharton saying, quote, if the economy is fundamentally much stronger than we realized on the margin, that would tell me rates probably have to go a little bit higher and then be held higher for longer to cool things off. JP Morgan's Jamie Dimon weighing in. Tom, I know you have a lot to say on this, saying the world is not ready for a 7% Fed rate, and that going from 5% to 3% is going to be more painful than going from 3% to 5%.
These are two smart guys, very different, but yet they're all on common ground here. They're looking at the probabilistic distribution of what we're going to do. And Dimon in that comment, which I'm going to suggest Dr. Kasman and Dr. Ferroli maybe don't agree with, but he's just simply looking at one tail, one outcome that could be out there. The aerospace engineer from Minneapolis has a key word there is margin. We heard a lot of Newtonian calculus yesterday. Kawa wore me out up at UBS. But the answer is people here are looking at the marginal, the first derivative, the second derivative within what we're seeing in bonds and FX. 106 DXY, I'm talking calculus.
Well, what I'm looking at is this idea that the risk is increasingly to the upside, and that everyone who talks says that the risk is the economy has that much more strength behind it than people expected at a time where we are back to pre-pandemic times when it comes to the savings rate for the vast majority of people in the United States. So is that accurate? Where is the risk? Is it going to be on the downside with respect to economic data, or is it going to be on the upside with respect to strength?
Talk to David Page here in a moment about these things. What else do we have?
The Senate It's nearing a bipartisan deal on a short-term spending measure. Sounds like it's progressive, right?
Certainly.
Could avoid a government shutdown. And Bloomberg reported the deal would extend funding for 4 to 6 weeks after the October 1st deadline. However, and this is the big caveat, could put a lot of pressure on House Speaker Kevin McCarthy, because basically, Tom, if he has to bring this to the floor, he could face some sort of loss of confidence vote that leads him to lose his position and then total disarray in the Republican Party.
Folks, can they just talk to Maya McGinnis? I mean, that's, talk to somebody sensible about this.
Yeah, well, part of the problem is that do voters actually want to hear it?
No, they don't. No, this is
That's
the smartest thing I've heard on this analysis. You're 100% correct. Call up Orzag over at Lazard. He's expert on this.
Well, but this is the problem, is that essentially, can you have an honest discussion about finances if people don't want to hear the truth? And that essentially is what happens time and time again. I'll get off my soapbox.
China.
The crisis at Evergrande deepening after the company's mainland unit said it failed to repay an onshore bond, adding a new layer of uncertainty to the property developer's future. This comes as Caxton reports that the company's ex-CEO and ex-CFO have both been detained by Chinese authorities. I'm not sure what that's going to achieve. There is this feeling, though, of just deepening distress in the housing sector in China that is being allowed or at least uncontrolled by the government. And this raises a question, how far it will go and how much the exposure could be contagious.
And the devaluation of renminbi, where it's 7.31, no one ever thought we'd get here. You wonder, do you get back to that 7.52 level of 2015? You can say, oh, that'll never happen. But given the domestic balance sheet issues, that's how you devalue a currency.
You know what's funny, though? In so many notes that I've been reading, everyone's been saying they're going long China because it's gotten so beaten up in terms of the assets that people are like, well, how bad can it get? It's already basically pricing in all of this, and the government will help at least on the periphery. So we're talking gloom and doom, and other people are saying, yeah, we know this
You're
already.
talking gloom and doom, I'm not. Why don't you bring in David Page to holistically, he gets to work with Gilles Moek. That's pretty cool.
That is pretty cool. And Gilles Moek gets to work with David Page, which is even cooler. Head of macro research at AXA Investment Managers, joining us here on set in New York. And David, I want to start there. We keep talking about the balance of risks to the upside with respect to rates, with respect to growth. Do you think that that is the greater risk than the risk to the downside right now?
I mean, it certainly has been, and we've seen that come through in bonds, but I tend to think that we're really at a peak now. Going into the summer, we were having the debate, is it going to be a soft landing, is it going to be a recession? Coming out of the summer, is it going to be a soft landing, or are we going to have no landing at all? And I think that creates a dangerous backdrop, and I think you were talking about it a little bit earlier. So I think what we're seeing now is a backdrop where actually economic data are going to start to look a little bit harder. We're starting to see it in a little bit in the September sort of early retail numbers coming through, with gasoline picking up a little bit. We've got student debt payments coming in. We know that real disposable income growth is going to be slower. And we've got this excess savings story coming off before you think about the shutdown. So Q4 looks difficult to us. And I think once we start seeing that more negative data coming through, if we get it printed, then we're going to start to see a readjustment come through that actually it isn't quite as resilient as all of that. But I think the market reaction to date has been, we've seen this resilient economy.
Jamie Dimon's comments about a potential 7% interest rate did not speak to an incredible strength. It spoke to stagflation. It spoke to this idea that the labor market is imbalanced, there aren't enough workers, and people are charging, they want to get paid more. It's about the fact that workers at a lot of these smaller businesses are seeing costs all around them increase, and so they have to keep up, and business managers have to charge higher prices to keep up with that. Why is that not the reality, that any kind of softening won't actually decrease inflation materially the way that a lot of people were expecting?
And I think it will. I mean, our forecasts are, and if you look at the data, you are seeing a softening come through in inflation. And I think to Tom's point, you can create a scenario where you have to sort of see this sort of stranglehold on the economy. It just doesn't look necessary. In fact, what we seem to be seeing is a much more benign disinflation than many had thought. Unemployment's still at 3.8%, right? But you're starting to see this coming off. And we think that continues. But it does need a period of below-trend growth, we think, which the Fed is aiming for. And then you go back to this sort of immaculate soft landing, which, given what we're seeing come through from the investment side of the economy, we might just get. But I don't think it's going to be painless. I think the fourth quarter, we still see a contraction. We then see a relatively soft, particularly from the consumer, first half of next year. That being the case, that disinflation, I think, comes through. And I think the Fed acknowledges this. Listening to Powell a week or so ago, he wasn't saying we're definitely moving higher. It was a 12-7 vote between the committee as to whether or not another one came through. And all Powell could say every time he was asked is, we're data dependent. The Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
What does AXA see from clients, institutional clients, what you see just in general around the world in use of cash? What are people actually doing with the current yield on cash? So
the current yield on cash means that people are very happy with cash in a way that we've not seen for quite some time. Short duration funds are doing very well. People are a little bit uncertain. Okay. There has been a lot of uncertainty about taking that duration longer. But that's starting to fade. There's now a mood that with longer term yields at these rates, that they offer good value again. That not only are you getting a return.
So you're seeing a duration migration.
Yeah, starting to see that come through. And the duration now offers you some of the hedge against some of the risks that are still out there to the equity side, which has just not been present in long-term bonds.
Away from your remit, but nevertheless, it's in the zeitgeist this morning, folks. I really can't say that enough. Is the speculative bet, given the uproar that Lisa's beautifully framed this morning, and that is, are we setting ourselves up for the mother of all 2023 short squeezes?
Well, I think we are going to get a real...
And bond squeezes? I don't mean just the equity market.
Yeah, no, I mean, we think that the peak has been reached in yields. We think that there is a risk of quite a meaningful adjustment in risk as we go through the fourth quarter. Because I think, different from the start of the year, when markets thought, there is a good chance of a recession, and therefore the Fed's going to cut aggressively, and that eased financial conditions, you've now got this opposite narrative coming through, which is the economy is really resilient. Longer-term rates are going to stay high for a long period of time, and against that backdrop, it's more difficult for companies, and we're starting to see that coming through even in S&P pricing, but in risk more generally. So that tightening in financial conditions, I think, is starting, and if we start to see economic data soften over the fourth quarter, which we think we will, I think markets are going to find it difficult to differentiate that between a genuine start to recession story.
How much conviction do you have in that, in the sort of load the boat and 10-year yields?
We think that, we have a reasonable amount of conviction in that, but we do see risks on both sides. I mean, we've just adjusted our view, given what we've seen over the last few quarters, particularly in terms of investment, that we don't think we're going to see a recession. We thought that we would see a mild recession. We now don't think that's the case. But the top-line indicators are still there for that, and yet we have to be mindful that, particularly with excess savings, there are also risks to the upside as well. So I think, for the first time in quite a while, we see risks both sides of our view, that actually we achieve a relatively modest pace of growth.
It is my job to be gloomy and to be perhaps a little bit skeptical of a lot of the optimism that Tom talks about. It is in my DNA, unfortunately, for me and probably for people who listen to me. But there is a question. People have to sit on set with me. But there is a question as I look at all of these moves, and Tom was pointing to the dollar and some of the moonshots that we've seen over the past couple of days. I look at yields as well. When does something break? Are you seeing any vulnerabilities in particular sectors that are reaching fissure points in a material way?
No, I mean, we've not identified those fissure points, but, it's like Larry Summers said a little while ago, against a backdrop of these rising rates, you are going to get problems coming through. We've seen it in the UK a little while back. We saw SVB. They've not been sort of systemic. We don't expect a systemic risk, but there will be people that are coming under pressure. Leveraged loans, small businesses we talked about a little bit earlier. All of these are not insulated from the significant tightening that's come through. Right. And that puts pressure on financial and non-financial firms. And it's likely that somewhere something blows up, but identifying those ahead of time is always difficult.
We've made double digit, somebody told me, in 60-40, 60% stocks, 40% bonds. We had a nice recovery off a bloody 18 months. Can you reaffirm 60-40, or do you have to do something creative at AXA?
We have a range of funds at AXA which aren't just based on 60-40. Our global thematic funds have been some of the sort of...
But is there efficacy in 60-40 out 36 months?
It's not something that we sort of put much weight on particularly.
Okay. David Page, thank you for the brief. With AXA Investment Managers, working with Gilles Moak, among others, out of Paris, New York, and London. Lisa, one of the things that we haven't talked about enough today is futures at -20, and the equity market did not have this weight to the tape yesterday before the Hail Mary recovery late in the day.
Do we trust these moves? Is this sort of a move?
Here we go.
I mean, in seriousness, there's just no conviction right now in markets. Let's be honest. The only conviction that we've had has been short bonds, right? Has been this idea of yields going higher, and are we hitting that breaking point? People say they're going to buy, and then yields keep going up, which is the reason why I'm curious about that 1 p.m. auction today of 2-year notes.
Post-pandemic, in the media roulette wheel. I'm as guilty. Pharaoh's not guilty. I mean, but you and I are guilty.
He's
Pharaoh's
never
not
guilty.
He's never guilty. Is the panic over a correction, a bear market, or something worse? Let us recapitulate the drawdown banner from yesterday. One of our interns redid it for us as well. There it is, drawdown. We had Biden up there in the UAW strike. We'll get to that. Drawdown, SPX, -6%, down -5%. NASDAQ, 100, the beautiful 7, cratering, I say, -7%. In the old days, these are, like Laidler said, October of 87, the VIX was 150. We're nowhere near sweat. We're nowhere near blood on the streets.
It's interesting that people are focused on the downturn, on the downdraft, on the, correction that you want to talk about, which is barely a correction or not a correction. It's because it's so rare. We have not seen these stocks go down, and I think that's important. And that's something that people talk about. Citigroup analysts coming out today and saying that there are a pretty big amount of short positions being put on the NASDAQ, and yet again,
yeah, I would watch that.
We don't see it, not yet.
Yeah, the short squeeze, I'm not going to predict that, but let's remember that's a short-term phenomenon. We're also looking at the long-term phenomenon. Looking at the oil market with our great team and Javier Blas is Will Kennedy. He will join us here. It's a quiescent oil. Brent crude, $92, $93 a barrel. What's next? Futures at -21. The real yield, 2.15%. Wow. Bloomberg surveillance. Good morning.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
continue to see volatility in the $80 to $100 oil price environment right now. But I think the higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe.
Is $100 a barrel now a different $100 a barrel? That's one of the arch calls, the zeitgeist at the end of September. The Bramo Cam catches Lisa saying yes. Lawler, Douglas Lawler, Continental Resources CEO with Alex Steele talking up there. You're nodding your head. You're going, this time is different.
I'm not going to weigh in one way or another. The argument is that if you see inflation take prices up more generally of everything, then this is an economy that can withstand a $100 barrel of oil in a different way than, say, 10 years ago when $100 had a very different buying power. And I think that is the argument of the likes of Christian Malik over at JP Morgan.
You know, it's great here. You know, I was in London. I was in the food court. You know, they have real food over there. We don't. Protein and, you know, strange things like that. And I'm up against a porridge. You know, they
have actual porridge.
We have Quaker Oats, like little cutesy bags full of sugar and chemicals, and they have vats of porridge brought in from Claridge's.
Oh, yeah.
It's great. So I'm standing there, and Will Kennedy walks up to me, whispers in my ear, cocoa. goes, cocoa. I go, I don't know where it is in the food cart. He goes, no, stay long cocoa, because that's what's happening in the commodity world as well. With futures at -19, Dow futures -130. I want to really reemphasize today off of oil, $93 a barrel, that it is bonds and the litmus paper of foreign exchange that we're looking at. I've got a 106 DXY, yen out at 149. We could stop the show here, Morning Drive Time America, and have people drive off the road on radio talking about yen. It matters, but it's distant. Lisa, you said you're looking at a sub 106 euro. Are we on parity watch? I mean, it's just simple.
Well, people are saying that something has to happen to get to parity, but still, the moves have been notable. The fact that we've dropped below 106. This is not a boring moment in the FX market.
Well, we're not seeing that. You wonder about trends there, as we see a trend in DXY. Will Kennedy is Senior Managing Editor, Trend Analysis here at Bloomberg, and he's got commodities trending like cocoa, like sugar, and a few others as well. Will, those are softs. Is oil trending like cocoa? Is oil technically like in place to drive ever higher?
A lot of people certainly think so. Mr. Lawler certainly thinks so, based on the interview that we had with him there. We've taken a bit of a breather, clearly. We're back down, back from the 95 that we're at, but I think a lot of people believe that that trend is still in place to take a run at $100 a barrel, and that's driven by the continuing tight grip that Saudi Arabia and Russia is keeping on global supply, and what looks like fairly robust demand around the world, and a realization that fossil fuel demand continues to grow, and that a reopened economy is seeing record demand for oil.
You know, what a great conversations, Will, we had, including with you, and an appearance by Javier Blas on surveillance was treasured in London. But Will, I look here at the arch question, is this time different? Within all of our reporting, how is this belief in $100 a barrel different from the last time around?
I think one key difference, Tom, is that $100 today is a very different to $100 in the past, and that if you talk to people in the Middle East, they would tell you that $100 is a pretty fair price for their oil, given how much the global price level has risen since. I think one of the ways to see this situation geopolitically is that Saudi Arabia and the other OPEC producers want what they see as a fair price for their barrels. They see the purchasing power of their dollars have fallen away, hence this drive to get oil higher. So I think that's one way in which it's different. The other way in which it's different, of course, is that, you know, there are ways in which demand can be substituted. And one of the key things that people will be looking for as we go forward is, if we do get to 100 or more, what does that do to demand? What does that do to demand for EVs? What does that do to demand for air travel as jet fuel prices rise? And I think people are looking for that spot where demand destruction starts to kick in.
And well, one thing that we heard from Oklahoma City in the conference that Alex Dio was at yesterday is that it's not going to happen at $100 a barrel, and people are seeing renewed buying. It certainly isn't happening at $90 a barrel. One of the interviews was with Harold Hamm, the billionaire who oversees Continental Resources, and he said that oil prices will go to $150 a barrel if the government doesn't support new drilling. Is this just a self-serving comment, or is this true?
Mr. Hamm likes to say provocative things, I think I would say. It's not entirely clear to me what the government is doing to drive prices to $150 a barrel. Despite the rhetoric coming into the last election, the Biden administration hasn't done an awful lot to slow down shale drilling. What, in fact, has probably slowed down shale drilling is two things. One, Mr. Hamm's investors, those people who invest in the shale industry in Wall Street, are demanding an emphasis on cash over volume, and that's been a big sea change for the shale industry. It's not about growing your volume, it's about returning cash, making profits. That's the first thing. And second, for many shale producers, and I don't necessarily include Continental in this, you know, they have drilled the best bits of their holdings, and that, you know, the days of really, really rapid growth are harder to achieve. There is a secular slowdown in the shale industry. And I think most people, if they were looking at it objectively, saying those are the factors holding back shale demand rather than the tight grip of government regulation. I think there's a lot of rhetoric in what he says.
And you could take the other side of this, especially because we heard David Solomon from Goldman Sachs yesterday at that conference talking about how it would be folly to move away from financing some of these fossil fuel companies, that you still need to invest in oil and gas in a more material way. And we've heard this from others too. Basically, it's a reality check. We're still using some of these materials. So if that's the feeling from banks, won't some of these projects be financed more now than 2 years ago? Isn't there more of a sense that there is actually open financing available to some of these companies?
I think that was the really important comment yesterday, actually, that you had the chairman of one of America's largest banks saying clearly that they don't want to retreat from this industry, that this industry remains an important part of the American economy, and the bank will be there for them. And I think this is a big shift in approach from perhaps a couple of years ago, where CEOs like Mr. Solomon would have been a little bit more reluctant to say that directly. Of course, you know, he's in their backyard and it's the place to say that, but the fact that he went there at all to say it, I think is very interesting, and clearly, you know, there are people still willing to finance the oil industry.
What's the biggest concern for you right now, Will? A barrel of oil in the U.S. or natural gas over in Europe? We saw prices really increase. We've seen a real disruption from some of the strikes. And we're heading into a rainy, colder season, as we learned when we were over in London.
Yes, I think there are clear risks for both markets, actually, and that we will want to keep a very, very close eye on the weather and see how cold this winter gets. Clearly, Europe was saved last year by a pretty mild winter. But if we look at gas, yes, we're in a good position. The strike didn't happen in Australia. Stockpiles are very full in Europe, but it remains a very tight market, and a sustained period of cold war, a good thing. And then again, if you look at diesel, at fuel, the refining industry worldwide is stretched, and we're constrained by how much fuel we can make. You see Russia ban diesel exports for a short while. We'll see how long exactly. That tells you that governments are worried about getting enough fuel to their customers. So a cold winter could make for a very interesting energy market.
Will Kennedy, thank you so much for the brief from London there on the hydrocarbons, looking at West Texas Intermediate back under 89.02, Brent crude under $93 a barrel. Lisa, what are you looking at on the screen? Equities, bonds, currencies, commodities.
Well, I'm actually thinking about what Will Kennedy was saying there, that basically if you have Goldman Sachs making the trip out to Oklahoma City, if you have these financiers basically saying, we are going to keep financing you, we are committed to doing that, well, then doesn't that increase investment at a time where people are writing it off and actually increase production down the line? I mean, really, some of the nuances here that go against some of the common belief that investing in fossil fuels is dead and that it's obsolete, maybe not so fast.
I used to be in seminars, and upstream, downstream, my eyes would glaze over because I couldn't figure out what was up and what was down. But the answer is, there's a belief here, folks, and Bloomberg's done great work on this, even Bloomberg Green, on underinvestment in hydrocarbons. And you've got to believe with price and a sustained Saudi belief in $100 a barrel that investment just has to come back, including from a Chinese. That's what's different from the 80s.
And how much does that go against what we were hearing from Christian Malik of JP Morgan, of this chronic underinvestment? And you can make an argument, well, it takes a lot of investment to really catch up over time. But still, on the margins, you're seeing people go into energy debt, go into energy equities in a way that they haven't for decades. And that, to me, is a big shift.
Your family drive a VW diesel Rabbit? That was a car.
65 Oldsmobile, cross country.
That was a car. People think it was like the yellow Oldsmobile GTO or whatever with the little wires in the hood. No. VW Diesel Rabbit was the cool car.
We had the windows down.
Yeah.
We had that little triangular window that you push out.
We didn't have a radio in it, so we couldn't listen to Bloomberg Surveillance Good Morning on radio, on television.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
in destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
On the next episode of Hello World, I head to Los Angeles, meet some robots, and eat too much of the most amazing candy ever created.
Is it safe to drink this much glitter?
Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
U.S. growth both accelerating and surprising to the upside. That's something that's going to change.
The U.S. economy near term will probably be slowing down.
When I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not.
What people have been doing all year, which has confused me, is sold bonds but said that they liked them.
Right now, we're still in the annoyance phase of inflation. That's why we think it will persist.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on radio, on television. Right there is what we're about. Katie Kaminsky and Eric Davis yesterday, each separately, equities and bonds, looking for price down, yield up. Bramo loved Monday, not so much in love with Tuesday. But Lisa, I mean, the toxic stew or brew of the last 48 hours is something.
Yesterday was a tipping point moment where we saw yields climb to levels that people didn't think plausible. And
Yes.
they basically were all saying that we had seen the peak about 6 months ago, and here we were reaching new post-2007 peaks in the 10-year yield. And today we're seeing a little bit of a bounce back, but not with conviction. And that raises a question, can we live with these rates? Why are risk assets holding in as much as they are? Yes, you're seeing a bit of softness today. And are we entering a new regime that looks unfamiliar to anything that we have seen over the past 20 years?
And I would stagger the data dependency. Yesterday, the 30-year bank rate, I don't have the mortgage yet, but 7.75%. That's an American statistic for our global audience that we're all, it's like the Dow Jones industrial average, 34,149. It's just a heritage statistic for our listeners and viewers. Can you imagine that breaking out and not going where Jamie Dimon's blathering on today, but the 30-year bank rate at 7.98%?
And what if that stays there, right? I mean, this is the issue. What if it stays there for the next 10 years or the next 5 years, the next 3 years, and people actually have to start moving, and you actually get price discovery in the existing home sales that have fallen off a cliff? Is that when you start to see things repricing, or can we deal with this? Are we adapting and adjusting? Are people basically managing through a world that just looks different?
But we're data dependent on the 26th of September. Michael McKee, 9 a.m. this morning, Case Shiller. I'm sorry, I'm not going to call it S&P Core Logic. Carl Case, Robert Shiller. That's the way it is. Case Shiller, we're going to get a negative statistic year over year. New home sales, who knows what we'll see. But that becomes the data path into jobs October in inflation if we don't get the dreaded shutdown.
Well, if you start to get disinflation in housing, that could be positive, right? If you get the idea of prices going down at a time where affordability is at a record low for the average American, that might be what the Fed wants. The shocking aspect is it hasn't been deeper. We haven't seen that 20% correction in home prices that you'd expect if you have a tripling in terms of mortgage rates. At this point, really, the issue is we don't understand the long and variable lags.
Let me get through the data. We got to sell a book here quickly for the hour. Futures were worse earlier, negative 18 right now. That's down 0.4%. SPX down 0.5% as well. The VIX 17.42 in from that 18 level yesterday. Quickly in the yield space, 4.50 after a higher yield. On the 10-year, real yield 2.14%. We got out to 216, 217. Will Kennedy tells me oil's stable. Right, Will. Dollar 106 DXY, yen 149-ish, rounded up. I'm going for the gloomier, folks. It's a Bramo data check as well. Coming up in this hour, Jonathan Farrell in conversation. They sold the movie rights to this book already. It's amazing. That was because of Gordon Brown. The Prime Minister of the United Kingdom, Gordon Brown, writing with Mohammed El-Arian and the laureate Michael Spence, Permacrisis. And this is a primal scream about the technology, think Spence, buttressed up against the game theory, think El-Arian, many T decisions in the book. And then Gordon Brown about the politics of how we extract ourselves from the emotion of the time. John Farrell with that later in the hour from London. We need a brief.
Tremendous conversation, which I'm looking forward to. Today, we do get economic data, including the S&P Core Logic Case Shiller housing price data that comes out at 9:45 a.m., as well as new home sales that come out shortly after, and Conference Board consumer confidence. I am curious to see how much that downdraft in valuations accelerates. Do we see an actual correction in a market that is not a market because houses are not moving and in the existing home space? The new home sales, yes.
Yeah, okay, but my tie-in is what to rents? How does this come over to rents? And there is rental disinflation across America. You and I don't know that in New York. But come on, rents are disinflating.
They are disinflating. Some nuances around that. All really important things to watch because they feed so heavily into the Fed's inflation gauges. Then at noon, we do see President Biden joining the picket line with the UAW workers in Wayne County, Michigan, which is going to be really a pivotal moment, the first time in more than 100 years that a sitting president has done that.
We don't want to stop the show for my thoughts on this, but just, would Harry Truman do this? What Truman took from the unions, I just don't think so. Truman is after FDR.
Thank you, I appreciate that. Excuse me, I will get it out. The juxtaposition between President Biden and then the former President Trump coming the following day will be interesting. And then at 1:30 p.m. Eastern, Fed Governor Michelle Bowman speaking after yesterday we heard from Neil Kashkari saying one more hike for the remainder of this year. The risk to the upside when it comes to inflation, Tom.
Yeah, why don't you bring in Emily Rowland? Because, I was talking with Emily early in the season and, like the third week of April, I said, it's over. And she said, oh no, those Red Sox will come back. And, she and I really aren't on speaking terms.
Okay, I'll let you guys work it out.
The last place Boston Red Sox, they took the damn John Hancock sign down. What was that about?
Emily, I'll let you work it out with him in a little bit, but I do want to start Emily Rowland, co-chief investment strategist at John Hancock Investment Management. I'm nailing everything this morning. I'm curious, your perspective. When we look at some of these yields, are they sustainable? Does this look logical that we could see a 10-year yield at 4.5% and heading north?
Yeah, it's unbelievable, Lisa, the backup that we've seen in yields, and it's seemingly on no news at all. Last Friday, we were kind of combing the headlines trying to figure out why the 10-year Treasury yield had backed up 10 basis points in a day, and it was really no news, no economic data. This feels like a move that's very much driven on sentiment, very much driven on technicals. Maybe it's liquidity fears, maybe it's supply fears. But we see the cycle as being a lot more relevant. In fact, if you look at this backup in yields against the macro backdrop, it doesn't really make a ton of sense. You know, you looked at headline CPI at 9%. Yields were lower then. I look back at 2021, manufacturing PMIs were 63 in the United States, and 10-year Treasury yields had a 1 handle on them. So what we've seen is that yields have moved higher, even in the face of this sluggish economic growth, this decelerating economic growth, and this moderation in inflation. You guys have talked a lot about the housing market this morning. We're seeing disinflation in housing, and in fact, housing prices on a real basis, you talk about real-time measures of rent, are probably about flat year to date. So it's very strange to us to see yields backing up to this extent.
Emily, the difference between you and me is in my youth, the Red Sox never, ever, ever, ever won. They were always disappointing. And you, of course, know all those glory years. Now, here we are, the end of September. We're both crushed by the last place Boston Red Sox. And my question is, like the Red Sox, is all this gloom and tension in the market, is it seasonal? Is it just the month we're in, the week we're in?
Yeah, I mean, September is a notoriously difficult month for markets. You know, we try to look past that. There's all sorts of data out there right now suggesting, hey, when September's bad, then we're going into a positive time for seasonals. All of these are sort of shorter-term gyrations in the market. You know, I do think that it's possible that we'll see some volatility. We're going to start to hear more from corporations when earnings season picks up next month. It's just hard to see what the positive catalyst is for markets today in an environment, again, where the economic data is slowing. The cost of capital is incredibly elevated right now.
Right.
You know, obviously it's hurting consumers. There's major headwinds. You guys have talked a lot about this morning, everything from oil prices rising, which acts as a tax on the U.S. consumer. We're seeing mortgage rates approaching 8%. Auto loans are the most unaffordable in U.S. history. Right now, the labor market's looking fine, but eventually the consumer is going to start to do the math when they look at the restrictive cost of borrowing and potentially pull away here.
You beautifully explained that. So I got a cost of capital issue with a real yield up new. A lot of people have never experienced this. Seriously, folks. And so that comes down to what I call the choice set. I'm talking, you know, Eulerian here, game theory, and that by definition with an elevated real yield, don't I have fewer choices in my set of opportunities?
Absolutely. And what we're really trying to do here is minimize our exposure to companies that need to issue debt or equity in this market. We look at unprofitable companies, growth at any price companies. You know, when you go way down in market cap, for example, the Russell 2000, 45% of it's comprised of companies that don't make money. That's not where we want to be in this cycle. One thing that we're watching really closely is we're finally seeing defensive equities perk up. And you can give me a hard time on this one, Tom, because I've been talking about defensive equities since the spring, and I've been wrong. You know, who needs defensive stocks when you can, you know, own tech stocks that are up 40%? But I think that, yeah, right. I think the baton can be passed there. And you look at the ratio of defensive equities to cyclicals, it's perking up. And I think these companies can get a bid as we head into this more challenging macro backdrop to close out the year here.
And what's great about this, Lisa, down Boylston Street in Massachusetts, where arguably this is where mutual funds were invented, in the ether this morning are convertible bonds. Well, yields are so out of whack that the new stock is a 5% convertible bond.
And any kind of bond, actually, which is what we heard from Jim Zelter over from Apollo. But I am curious, Emily, one of the challenges to conservative stocks is it's unclear what that means. A lot of people are saying that is big tech. How do you define it?
Well, we still do like tech. And again, it's your classic S&P 500 tech sector, not your growth at any price tech, because tech is the poster child for quality. These are companies with awesome balance sheets, tons of cash on their balance sheet, a limited need to tap the capital markets in order to grow. But we all know that tech has gotten expensive. And so we want to think about using technology stocks to protect portfolios from solvency risk, but we also want to protect stocks from valuation risk. So I think you need to comb through the value side of the house. We don't love everything value. I think you need to be selective here. Sectors like healthcare, which have a 20% ROE, they're trading at a 10% discount to the market. They've been left in the dust I think these are all areas that can really do some more heavy lifting in portfolios.
You know, Emily, fall out of old John Hancock up in Boston, wander over to Trinity Church, sit on the front stairs there, looking at the Copley Square pigeons, and pray for a shortstop. Emily Rowland, thank you so much. In Boston, beleaguered Boston, with John Hancock this morning. You know, that was a brilliant conversation about, and at least, you know, I bust your chops all the time, but you can't go up without fear. Cardinal rule. We're going to have to discuss that through the coming conversations. Later, John Farrell on permacrisis. Good morning.
Right now, we're looking at S&P futures down about 0.5%. You could see the NASDAQ futures lower by 0.6%. And Tom, as we look toward this, there is this issue of what does defensive mean? What does it mean to be cautious at a time where the rules have been flipped on their head? And I actually liked what you asked earlier this morning. Does 60-40 work in a year, in 2 years?
It's a brilliant question. Yeah, I mean, this is a really, really serious question. Of course, this comes off, and Lisa was way out front on this, folks. The Bloomberg Total Return Index is plural. Whatever you look at here, it's been an ugly 18 months. And that was the destruction of the certitude, the confidence of 60-40.
Katie Kamensky was talking about that yesterday. She was saying we're facing yet another year potentially of negative returns. And if you take a look at the the Bloomberg Aggregate Index of Bonds, you can see it's poised for a third straight year of negative returns. A third straight year for the defensive bet du jour, which is the reason why, actually, the dollar is the reason why it's become so interesting. We heard that from Ross Kostridge earlier this morning, that that's actually the main hedge, more than any bond.
And you know, I take real issue with this. Lisa's expert at this, but everybody talks about the present. In bonds, they never look back like in equities. And the answer is they've got a spread, a strategy. You know the fancy lingo better than I do. The answer is price down and yield up, and we've had 18 months, 24 months price down.
And when will people start to care about that?
Retirees care right now.
Yeah, well.
Fancy Wall Street pros maybe don't care, but I think Jim Caron at Morgan Stanley cares because he's listening to Mike Wilson. Mike Wilson of Morgan Stanley, 8 o'clock hour. In 30 minutes, John Farrell on permacrisis.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
From New York City,
From London and Sydney,
from Washington,
and Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
If you're running a business today, you have no idea which direction Washington's going in tomorrow, and whatever direction it's going in tomorrow, it might change directions after the next election. Wow. That's a tremendous level of uncertainty. I think a potential government shutdown, actually just confirms that level of uncertainty. Wow. And that's a wet blanket on any business and a wet blanket on the economy.
A Business View, Neil Bradley, U.S. Chamber of Commerce Executive Vice President there, with a lot going on here. We're going to get to this in a moment. We really haven't touched on it with the markets today. Futures negative 22, the VIX 17.58, the 10-year yield 4.51%. Excuse me, all of this elevated in the last number of days. I'm watching a real yield 2.14%. And Lisa, let me run over. I'm doing this on the Bloomberg Professional Service in real time.
You get royalties every time
we
you say
can do that. I know I do. No, Mike lets me keep my job. 7.75%. We don't have a 30-year mortgage print today. And that's something that you think on Air Force 2 or 1 or whatever he takes. Maybe he'll drive the car to Detroit. But the president today, he's got to be focused on the housing market as he is on UAW as well.
The fact that people feel these higher rates as well as higher inflation. And he is going to be in Michigan. We haven't really been talking about that. We've been talking about the government shutdown, which feels imminent, the Senate plan. But Anne-Marie Hordern joining us now, Bloomberg Washington correspondent, really to answer a question that I have been unable to answer, which is, Anne-Marie, what is the political implication from President Biden going to Michigan? Is this being really well received, or is it being highly criticized?
Well, I think the president wants to make a political statement. He continuously says and ran a campaign that he is a boy from Scranton and he is the most pro-union president in modern American history. And as I said yesterday, he's now really putting his money where his mouth is by actually going to the picket line. And the White House is really trumpeting this as the first president to do so in modern American history, maybe actually ever. The only really moment I can see as an individual putting their thumb on the scale for the labor union had to be the early 1900s with Teddy Roosevelt and the coal miners when he had them at the White House. So this is a big historical moment for this president, and the White House is touting it. Also, if you look at the polls, 1 in 6 Americans, Gallup did a lot of research in this in August, given the hot labor summer, but 1 in 6 Americans come from a union household, and about 70% of Americans support labor unions. So politically, I think the White House views this as very helpful for his reelection campaign next year. On top of that, the former president, Donald Trump, will be going on Wednesday. So he is able to go with an invitation from the UAW leader, Shawn Fain, not just showing up on his own accord, with an invitation from the UAW and what the White House is calling stand in solidarity with those union workers.
As you said, he sort of got political insurance because the other side is trying to make the same case. So it's not as if there is sort of an argument to be made of pro-business, support the profits of the big auto manufacturers. What is, though, the response from some of these auto manufacturers? Are they just being quiet and sitting there and watching this all unfold?
I think they've just been quiet. They understand the politics at play. They obviously want to also make sure that they can get these negotiations under wraps, right? This is the second week now we are seeing these protests and these strikes, and potentially the worry for them would be if they start to expand and they start to hit other plants. Ford, because it does seem like they're ahead of these negotiations with the UAW decided actually not to expand in hitting some of those plants. I think they understand the politics of the moment. At the same time, the president has made pretty clear, and the White House continuously says, I mean, Karine Jean-Pierre was asked about this relentlessly yesterday, and she made clear that they are not trying to inject themselves in the negotiations. The president just wants to stand with workers. The president has said, he said so yesterday, that the workers are part of the reason why the auto industry was saved. And they took a lot of cuts over the years, and now they deserve to make some of that up.
Anne-Marie, you're always great at the history, taking it back to after World War I there in the trauma. I thought of Harry Truman, this is before my time, Harry Truman saying to the steel industry, we've got a war in Korea, you're not going on strike. He took over the steel industry. The Supreme Court said, no, Mr. President, you can't do that. This is April 8th of 1952. And what it was really about, Anne-Marie, was who's supporting business. Now, I don't want to get all Henry Cabot Lodge on you, but is there anybody in Washington supporting the automakers?
Well, here's the issue. There is support for the automakers, but it is politically unattainable to come out and say you do not want to see workers have higher wages.
Where have we lost the Chamber of Commerce vote?
I don't think they're not saying they don't support business. I think they are trying to walk a line that is that they are very pro-business, but at the same time, they want to make sure that workers are getting a fair wage. Republicans easily turn this around and say this is caused by the fact that these workers are asking for a 40% wage. I think they lowered it actually to 36 at this point. That is because of inflation, and they need to keep up with higher grocery bills. They need to keep up with gasoline prices. They need to keep up with higher rents, and they are putting it squarely back into that this is a problem of the Biden administration's own making.
Lisa, this is to me critical. This is not a Bloomberg surveillance topic. It'll be like 8 pages in the Atlantic or Bloomberg opinion or that. But this is Pelosi, Wall Street, Main Street. Who's supporting Wall Street anymore in America? Let me know. Right? Mitt Romney, and he's retiring.
I would take a step back and actually view this very much in an economics lens. And I'm curious what this means for wage inflation going forward. And Anne-Marie, the signal being sent when right now the discontent around the economic state of this country has to do with the fact that inflation is so high. It's forget about whether it's disinflating. People feel it when they go to the grocery store, et cetera, anything in their lives. So at what point, as a presidential candidate, do you have to come out in favor of higher wage increases just to keep up, which actually supports this idea of a more inflationary push for a longer period of time?
Well, the Barron's this morning has a great piece on how economically this could be a can of worms. And if you ask Jay Powell and the Fed if they enjoy this strike right now, the answer might actually be that this doesn't actually help with their Fed rate hike cycle. Because what can happen is, obviously, you want to see wages outpace inflation, but inflation is so high, and you have to see wages really outpace inflation. That's when you can have a cycle like we saw in the 1970s that is just unattainable right now. I don't think this administration is going to want to get into the weeds of any of that today. They are going to want to avoid the word inflation, and they are probably going to want to avoid the words EV transition, which is really also the bedrock and the tension with these discussions between the UAW and the big three. But that's what makes this moment in history and in the economics and politics so interesting, because not only is this a hot labor summer with the support of the most, as he self-described, most pro-union labor president, but also the fact that the Fed is actually trying to tamper down inflation.
Emery Horton, thank you so much. Greatly appreciate it. And of course, balance of power driving this conversation forward, I believe, after the president visits Detroit and, as reported, visiting the picket line as well. I just wonder, Lisa, I look at the President Trump's phrase, Republicans in name only, and maybe there's Democrats in name only as well, but just the middle ground that says maybe politically we should stay out of industry warfare like the Supreme Court told Harry Truman a lifetime ago.
I'm still thinking about what Anne-Marie said, where she said, the automakers understand the political posturing, and they're taking a step back. There is a difference between what you say and what you do, and the idea of expressing solidarity with workers who are angry about their wages not keeping up with inflation, about their wages not keeping up with profits, is a theme that you're seeing across parties. And what I find interesting about that is that laying a policy groundwork for wages to stay higher and keep going higher for a longer period of time. In other words, sort of making this inflation more entrenched.
Futures negative 19, the VIX 17.47. Yields, I guess it's sort of quieted down here before that 9 o'clock housing data. In 15 minutes, we are going to introduce to you worldwide, with the good work of John Farrow, a book that says, Lisa, we've just staggered from crisis to crisis. Ian Bremmer says of Brown, Allarian, and Spence, vivid detail, perma-crisis offers hope and good sense in equal measure.
I could use some of that. I think hope and good sense would be very welcome by a lot of people right now. I think that it's difficult when people are just trying to patch up the mistakes from the previous couple of years, and that seems to be where we've been.
What I love about this is these three guys have really differing skill sets. I mean, you can pick a Venn diagram and put it over it and all that, but it's going to be an interesting conversation just about the technological overlay that we've had. We'll do that with John Farrow here in about 16 minutes. The S&P 500 down 0.4.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg Savannah's futures -16, worser than Monday with that equity Monday recovery that we saw, but a little bit of weight to the tape. VIX, not the 18 level, 17.33. NASDAQ down 0.4%. SPX, I'll get it right, down 0.4% as well, 4.49%. It's a calming market here this morning. We're going to get to a massive must-listen global Wall Street conversation here with Kathy Jones from Schwab here in a moment. Publishing, Ian Lingen publishes. He says he likes the skepticism out there, a la Kashkari, and the reaction to that. Torsten Slok Publishing moments ago at Apollo. Thank you, Jim Zeltner, for that conference in London. Was that cool?
That was very cool.
It was very, very cool. And Torsten notes that the cost of money is beginning to affect venture capital. And to me, Lisa, this is a huge deal, this permeation of the real yield, the new yield back to 06, 07. It's a whole new world after all.
Yeah, I mean, we were talking about Instacart and ARM coming out with IPOs, and the buried news was it was a fraction of what they were valued at a year or two ago. And the IPO price has actually gone down in the real market after the IPO.
It's FX Tuesday, 106 on Euro, exactly 106.00. I noticed sterling under a 122. Farrell may not come home. 121.88, weaker sterling over the last number of days. Swiss franc doesn't give me love. I do not get stronger Swiss franc off that, which is of note, and we've barely touched. I got a yen, 148.88, rounded up 149, yen at a 150, gives pause worldwide. We're going to do under surveillance quickly here because we have an important global Wall Street guest.
All right, well, we're watching this. President Biden joining the picket line in support of striking UAW workers. He's heading to Detroit around 12 noon. Meanwhile, tensions between union workers and Ford have been ramping back up because the company is halting production on a $3.5 billion battery plant in Michigan, with scrutiny coming based on Chinese backing for that factory. This keeps percolating out. Tom, to me, the most interesting aspect of this whole story is how it really supports wages going up and how it gets in the crosshairs of so many different debates and is so messy. It is so hard to sort of parse through the strains of trying to support business, trying to separate away from China, and also trying to make sure workers get fully compensated.
I was reading a vignette, I'll give credit to The Economist, on Europe and China in EVs. And to me, there's a massive OBE. There's just a massive overcome by events here to this manufacturing race on new technology.
Okay, I'm going to quickly move on and get to the Senate nearing a bipartisan deal on a short-term spending measure which could avoid some sort of government shutdown. Bloomberg reporting the deal would extend funding for 4 to 6 weeks after the October 1st deadline, so we could do this all again. And meanwhile, the focus really is on House Speaker Kevin McCarthy and his future if this does pass the Senate, because then he has to decide whether he brings it to a vote in front of the House, bitterly divided against some of the protests of some of his more hard-leaning constituents, and could this lead to his getting a loss of confidence vote? at a time where there's nobody who could really take his place.
Stay with Bloomberg surveillance folks. In surveillance shutdown central, we have a team of people led by Michael McKee and Anne-Marie Horton to look at this.
We also have a team.
I do read the blurb there. Shutdown central.
Shutdown central.
Yeah, I want a countdown clock.
Yeah,
please.
Yeah, it's going to be just a perpetual, ongoing one. U.S. billionaire Citadel founder Ken Griffin. This is interesting. It's sort of the takeover, U.S. takeover of London. We've been talking about London football teams. Well, Ken Griffin is reportedly backing a group to take over the UK's Telegraph media. The auction for the publisher of conservative titles such as The Telegraph and The Spectator is expected to garner the attention of the owners of the Daily Mail as well. So we talk about all of these billionaires and hedge fund managers and private equity fund managers going into London football teams. Now they're getting into other forms of entertainment as well.
We don't need to run this as a clinic, but we talked about this in London, and that here, all the media is like, we don't have an opinion, but they do. And they're like, we have an opinion, buy our newspaper. It's much more vibrant over there.
John Farrow actually explained to me the genesis of that. And it actually makes a lot of sense, which is there were all these dukes and lords that owned the papers and had a point of view. And then it was just a stated point of view, whereas it was a sort of different generation of news in the United States.
Yeah, you know, and Mr. Murdoch retiring in tabloids, and not that I would ever read a British tabloid, and I couldn't get.
How many did you read?
I couldn't get past page 3. Continue if you would, please.
That's all I got.
Okay, joining us now, Kathy Jones, Chief Fixed Income Strategist here on higher yields, on the real yield. I'm sorry, even at Schwab, Lisa, it's been an adjustment.
Yeah, I mean, honestly, right now, people are looking at these yields and saying, can they last? And you were even saying yesterday, as you looked at them, why? So why?
Yeah, I do think that we are adjusting to this new world where we have a positive term premium and we have a stronger growth outlook and certainly, higher for longer yields. The question is, what is the end point of all that? And so when we look at it, what we say is, well, the Fed might hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here. So inflation is falling. Get a couple of more 0.2% month-over-month prints in PCE, and we'll be at 2.25 on core PCE. So we're almost there on inflation. The economy is slowing down. The housing market is basically frozen. You've got risks in the commercial real estate market that could spread back into banking. I mean, there's a lot of indicators here to suggest that they've done enough. So I'm curious to understand why some of the Fed members are still talking about raising rates even further.
Partly because the economic data keeps surprising to the upside. It's part of the reason why we keep hearing from different CEOs, Jamie Dimon, David Solomon, talking about resilience. And they're seeing it. They would see it first if they were seeing it really start to crack. Consumers are still able to spend, albeit not at the levels they previously were. So at what point do you lean into that and say, no, actually, maybe it's a screaming buy if you take a 10-year yield at 4.5% and you're willing to clip the coupon for the next 10 years. But are you really going to see that appreciation with some sort of massive decline in yield, increase in price that people were previously expecting?
Yeah, I think that we will see a decline in yield. Obviously, we're not going back to 0 or 1% or 2% or whatever, but I do think we'll see a decline in yield. So consumers are spending, but they're filing for bankruptcy. That's kind of the two-sided issue here. We're seeing a lot of delinquencies on credit cards, on auto loans. We're seeing defaults in the corporate sector. The speculative default rate is starting to pick up. I mean, there's a lot of evidence that higher rates are biting. It takes time to work its way through. The question is, does the Fed really want to send it over the edge? Or do they want to try for this soft landing? But, we think there's value in fixed income. You don't have to...
chart in the yield here. I'm going to get a little fancy here with Kathy Jones because she's a fancy person. I have nice log convexity. I have a beautiful 2 standard deviation trend and a higher yield. I've got elegancy on my Kleinman moving averages. I have a trend in place. How do you know when the yield turns and goes lower? I don't see that here. I see a higher 10-year yield.
Oh, you're right. I mean, trying to pick the peak is really, really hard. It is in every cycle, and this cycle has been, particularly unusual dynamics because of the pandemic and the fiscal stimulus and all the special things that have happened globally.
But I have an inertial force in the yield space to higher yields. how do I respond to that? Do I stay wicked short-term, money market fund, cash, and that? Or am I brave, fall on a knife, and dive in here, or dollar cost average into it?
Yeah, we don't fall on knives typically. That's usually not our
Liz Ann
advice.
Saunders does that. It's equity.
But yeah, we leave that for the equity folks. They can try that. But we're dollar cost averaging in. So we're looking at the ag with a duration of 6 and a yield of 5 1/4. And so mimicking something in that space, having a barbell perhaps, to do that, because you do get a lot in cash. You do get a lot in the short end, but you don't want to ride the cycle up and down because you're not getting any of the benefits, and you want to lock in some of the income. I mean, this is a huge opportunity for people investing for income right now. We haven't had this in 15, 20 years.
The concern that some people have is that bond vigilantes are getting a little bit stronger, and there are many more of them, and there are many fewer of the international buyers that might step in, say from Japan. How do you respond to that? Are you seeing the mix of buyers change and become more aggressive in their demands?
We're still seeing foreign inflows are pretty attractive, have pretty steady. So it's hard to parse the numbers because of the way they're reported through different agencies, but foreign investment's still pretty strong. So not too worried about that. I think a lot of it is the Fed's pulling back in QT, right? The Fed was our big backstop, and now the Fed's not buying. The Fed's allowing to roll off, and I think that that's one of the drivers of this. This last leg up here is you just don't have them stepping in, and that's going to be a factor. That's going to keep rates higher than they would otherwise have been.
Kathy, I'm asking for a friend, folks. The Austrian 97 year, I've enjoyed from a 134, I bought it just below that, like 131, to 36. I'm down 72% on a 97-year piece of paper. And on a stochastic basis again, how do you know when that's going to reverse and be the distressed debt buy of all time? When do you go long Austria?
Tom, I wish I had the answer to that. I think that you're going to...
But on a technical basis, we haven't seen this in 17 years.
Right.
I mean, this is, Lisa has no memory of this. What percentage of Wall Street has no memory of going, okay, when do I go long Austria? That question hasn't been asked for 17 years.
Yeah, when you go long, super long duration, I think you're going to have to wait for a pivotal moment such as a big recession or some sort of crisis.
Kathy, that was such a diplomatic way of answering a question where Tom is basically like, please, let me offload my Austrian piece, finally cash out. That's essentially what you're saying.
Yeah, no, it's not potentially what I'm saying. Folks, this is the dumbest investment I've ever made. I mean, I'm not kidding here. But Lisa, this brings up what Kathy and Liz Ann have to deal with every day. These are markets that what percentage of the public in their adult lives have never even listened to this surveillance dialogue.
And I'll take that a step further. The concept of distressed debt investing probably wasn't thinking about sovereign debt from top-rated governments, and suddenly we are thinking about top-rated debt from sovereign governments because that's the kind of yield that you're getting.
Kathy Jones, thank you for briefing me on the Austrian piece. Futures improve off that conversation. We were negative 23, now negative 15. The VIX 17.23. Bitcoin, Matt Miller says, why don't you people quote Bitcoin? 26,247. It'll be interesting to see. The Standard & Poor's 500 down 0.4%.
Coming up, we are going to hear from the perma-crisis, how to plan for a different and better world, the conversation that our colleague had with the likes of Mohamed El-Erian, Michael Spence, as well as Gordon Brown. I'm very curious to hear just some of the prescriptions and some of the angst that they have as they try to grapple with what the new norm is.
And what's great about this, and we're going to get to the piece here, it's going to be really quite interesting. You got a former rugby player. He got really hurt in high school and prep school. Gordon Brown really got hammered playing rugby. But he's like a Labor Party from another time and place, the political angst about what we do. Spence, who invented graduate education in America at Stanford, has a beautiful understanding of what's called asymmetric information, the things we can't see within a system. And then you've got the game theory of El-Erian and T-decision. So it's this toxic brew of three people. They went to Spielberg with this book, and Spielberg said, we can green like this.
Oh, yeah. I would watch it. Are you kidding? It's got my name written all over it. I will say.
Crisis.
It's so
Memorial
tricky
Day.
to figure out how to model the unmodelable, right? I mean, when you think about it, my father's a mathematician, and he once said to me, yes, well, I hear that, but he said to me once, in economics, you can create the most perfect model, but the parameters will be wrong. And that's kind of where we are right now.
That's Spence 101.
And that's where we are right now.
Spence's famous essay, I'm guessing 2010, on the certitude of all this regulatory solution. And he said there are things you can't see. And that's what you're going to hear. John Farrow in London in conversation with Brown, Alarian, and Spence. Coming up as well on your Federal Reserve, the Fed put, Julia Coronado, macro policy perspective. Stay with us. Futures at -15.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of